Good morning, everyone. This is Rose. Today is Friday, May 5th, 9 a.m. Eastern Time. Welcome. We have employment situation came out around 8:30 a.m. Eastern Time, which didn't make a big fuss. So this is what you basically got. The news bar right there. So came down, tested this area of interest, so limit order maybe there, or support. But 200, this is a 200 EMA and a 20 EMA, so it grabbed some of the orders resting there and then just goes right back up and closes here. And you can see that this is a one big trading range, so the limit order machines buy that close and stop orders enter above. The only problem entering there is that you're entering at the high of a trading range, but it's been tested once, tested twice. See, what happens here is that bulls are testing again, their stops are here. Their stops are here, okay? So what happens is market makers in an event like this, which is a news event, great way to run stops and kick traders out of their positions and then get them back in to create momentum in the opposite direction. So they ran the stops here. So these bulls who've been trying exit out, limit order bulls. So other traders start to sell because they see this bar. They sell. They think that these lows are going to be taken out. So they put their stops right there. And then the market makers, of course, just like any news event, they reverse the market right around a support level. So this is a support level, like I said. And then their limit orders get activated, so they're in. So now they go up and kick out those bears who sold this bar, okay? So, but they're playing against each other, okay? But there are also retail traders in between burning. So they run those stops and now go above it. So what they're doing is now coming back down. Might get another leg up, perhaps. We'll see. So that's the whole thing played in front of you since 8:30. Always remember, if you are trying to trade any news event, regardless of what it is, support and resistance is the only area, or supply and demand, okay, is the only area that the news bars will respect and will be stopped in their tracks, okay? So that's the only area that you're going to see reversals or slowing down, most likely reversals during news events. So always remember that. And if you want to trade news, then you may want to mark those areas ahead of time so you know when the news bar is going to be blocked, you know, on its path. All right, so I want to talk about yesterday. We talked about having a wedge here and a double top higher high. Bulls are trapped. Market, I talked about this neckline. There are a ton of, bulls and both this low, and maybe they were stuck up there. They, as the price came down here, so they're very disappointed. There are also bears sold underneath here, probably disappointed. So market now is back all the way to here, and they breached that neckline. But the one thing that they failed to do is closing a bear bar below the March 22nd low. Now, bears are trying to eliminate the measured move to the upside by breaching below this level. Well, it is prices right now at 41.0575. So we're going to open up right here. So we bounced, basically. We bounced in the after hours, okay? And we're going to be opening up like literally around here. So market might be actually going up to give a break even to bulls. But really the bulls actually are trying to get back up to these levels. So since we're going to open up here, there's about, I don't know, 70 to 80 points. Can market rally today? Well, today's Friday. Fridays we get big moves. Sometimes we get big moves to the both side. The weekly high and low, prior week's high and low, monthly high and low, monthly opens and closes. These are all important levels that you should pay attention on the chart. So I did say that we're going to come down and test the 50 SMA, which is this red line. A little bit more room to the downside. There are a bunch of gaps here that the bears sell somewhere here after giving the break even to these bulls and then come back down? Yeah, they might. They might come down because anybody who sold underneath April 26th will also look to sell somewhere up here to get a break even as well, because they're disappointed. If they were selling with stops, they're already triggered and they're not happy. So we could go up, we could come down. Market could go sideways, trying to prevent, bulls are trying to prevent this March 22nd breach, and they want to bring the price up. But the problem here is that we have a double top neckline. All we need is a bear flag. Like I said, we need that bear flag, and that bear flag needs a lower high. That means if we go and give these moves a break even, we can get that lower high, and then the bears would have a reason to sell, which they already have a reason to sell. So I think we're going to go up sideways, maybe come down again. So today is going to be a very interesting day, I believe. Yesterday, let's see, to fix this chart. Okay, so this is last week's range, right? So we tested the high, had a fake breakout, came right back down. This is still my target, and underneath, bears are targeting probably these areas. But the problem here is that we're already up here. So we're going to be testing, we're already testing the EMA on the 1 hour chart. Now we do have possible 1, 2, and 3, 1, 2, and 3 wedge. So we might come down, who knows? If this is a bear flag, which probably is, look at this first bear flag. We need another bear flag. We might need another one before we even decide to rotate. Now, could there be any measured move? Well, we did break this structures, then we went back up, then we sold. Now we have this structure broken, but the problem here is this big one, which we did not. But if this is too low to sell, which it was, so this pullback right here to a key level, which is the 20 EMA, could be a good reason to sell and meet the measured move targets and also tag this. We may not stop there. If we break this structure, that could give us an even much bigger measured move target all the way down to here. Okay, so, but the bulls need to back up a little bit. I'm sorry, bears need to let the market back up a little bit and then get to a better, higher price so they can sell better, mark it down and make money. Because if you sell low, you may not be, you're not making so much money, right? So your risk reward is bad. You're expecting some kind of a breakout. You don't know if it's going to come in. But if it actually goes to here, you could put a risk and then you could get your reward like that. That would be a much ideal setup. So I think that's what we're doing right now. We're pulling back up to this level and we'll see how this goes. Yesterday, we did a bit of a training session, but in that training session, I gave you guys what the 15-minute chart was going to do. And I warned you about this wedge top 1, 2, and 3. And I said, wait for bulls to bring the price up. And you have a channel here. We're breaching that channel high, and we're coming down. So bears want a bear flag. The only problem here is that we had a huge buy zone there, which I removed. And then I warned you guys, sometimes these patterns fail, and bears trying to sell once right there. Bears try to sell twice. They did make a low here, so if you don't want to count from there, I would understand how many times bears try to sell. And this would be it. Bears try to sell once, bears try to sell twice. They put their stops right there. and they failed. So now you get this bar. You see this bar right there? That's it. You no longer sell. If you're selling, get out, because they're going to run your stop right there. If your stop is there or there or there or there, this is where they're eyeing to get to. Okay, so once you see a big bar like this, after 2 tries failing, done. You got to exit out. You got to go long. Okay, so let's see where they went. Look, they ran the stops. Now they came up to here, but they haven't run these stops yet. So they might. I do have a area of interest, trading range. You see, we went up, fake breakout, and came back down. Double the amount of breakout to the downside, maybe even quadrupled it, right? So we definitely did that. And we have 1, 2, 3 wedge. Maybe there's a double bottom there, lower low, trend reversal. So it is basically grinding up towards this level. Yeah. Let's see. Yeah. And there's a gap there. So bulls want to close that gap, and they probably want to test here. But this whole area before the area of interest is actually resistance. Sell orders live here. Shorts live there, or bears live there, whatever you call it. So they're there. In fact, I'm going to take that wick and that wick. Okay. So I think this is where market is trying to go. Okay. Still going. Yesterday. Let me remove this. Turn into a trading range day. Is gap down, right? I said look for a trend from the open. You need 2 bear bars. First bar ended up being a bull bar, and then you got 2 really nice bear bars. So especially a bar like this, you got a you could do, initially you can measure that will be your measured move, and then you can also maybe measured from, I would take, as it goes up, I would take this middle. Okay, maybe there, but at this point we didn't reach there. But what did you get here? A second leg down, right? So market tried to have a bull flag, but problem with it is that we never got that bull body taken out that high, so that never, even if it did, that could have been a potential bear flag. And then what would happen is that everyone would buy it, and then suddenly we get a big wick, and that is a trap of the bulls, and suddenly you get a nice bear bar. After that, everybody sells, and the sell stop orders get activated, and the market come down. Now that didn't happen. In fact, bears decided to sell right away, and that was it. So this was a failed flag, and also gap right here. Your buying is into a climactic bear bar 3. There are sellers waiting there. How do I know where the sellers exactly? When I look at this and I don't see any of this, how would I know? I mean, I do this demonstration all the time. I measure a climactic bar, right? So, and then I apply my levels. I divide it into 3 sections. And this is where I'm going to probably have a sell order. Okay. Or there. Waiting. Maybe even at the high. Or the latest right there. Look. In between that and right here. Right inside the upper 1/3 of bar 3, sellers showed up. And comes down and tests the midpoint and upper 1/3 and sells again. Sell. All these sell orders are activated. And the market comes down with another leg. But there's a breakout bar. Bar is 12, but no follow through. So that's problematic, right? Which we talked about. I said, when you see this failed follow through, and what they're going to do is, anybody stuck here, they're going to sell. They're probably going to sell breakout bars 2, 3. Okay, so limit order market right there, bears waiting, limit machines. They're going to sell, and they're going to get break even with bar 14. And then I said, watch, because this bar is not taking one tick underneath bar 12, so it's going to go up. But there are still bears trapped there. And it's because they were expecting, they might have sold, which they did. Look, bar 14 and 15. Look at the bar 15 body. They sold the 14. Okay, so they're hoping to get a follow through bear bar, maybe even take this low out. Instead, they got a bull bar. So what are they going to do? They're going to look for 2 consecutive bars. One of them is strong, and they're going to sell. Maybe they're going to sell there above the bar. Maybe they're going to sell that open. Okay, so maybe they're going to sell somewhere average in that upper wick. So these are all sell orders activated, okay, somehow, and the market came down, right? And it probably gave them a break even. So if you sold there, maybe in the upper 1/3, look, is break even right there. So market, did they actually get their break even by selling that? Yes. Did they get their break even by selling at the high? Yes. So every single bear machine, limit bear sold here, there, got a break even and exit out, and not able to get any kind of follow through bear bar. They exit out. Because they rush out, you get this bid bar as a result. They're exiting out of the market, bears, and then bulls are joining, and so you get this. But market is very forgiving. It gives you a wedge, right? So now it's testing this gap, and this gap did not close. When a gap doesn't close, it's going to rotate. Where's it going to go? It's going to go to the next gap, which is from up to here, and it's going to try to close the gap. So you need a bear body overlapping with the high. They sell. So other bears will sell up there. They're still hoping to get back down here. Market puts us in a trading range at this point with this event. So what are you going to do? You're going to find your boundary lines. So you're going to take this. So far you're seeing this. You're going to apply your trading range. Right, so I'll do that. I'll take that out of the way. This is your trading range. This is your buy zone. This is your sell zone. Okay, do nothing in the middle. They're buying even at the lower second tier. These are your boundary lines. In between is 50% of each 1/3 level. Buyers show up, I buy, and I'm going to take profit there. I'm going to scalp there. This is what I want to see, market going up. But a big bear bar, and they come back and test that boundary line, and then second entry long 1, 2, I'll buy again. This time I'm going to take profit there, and I'm going to leave a runner into here. See, I made money there. They even try to go up there, but this is where I scalp. None of this was mine. I exited out there. Now you have it inside. These 2 inside bars, this is not an ideal inside, but it is. Both the 50 and the 49 are inside 48. Basically it's going sideways. So it's a balance zone. It's gonna start an imbalance soon. It just needs to test the highs twice and test the lows twice. So finally look what happened. Bears came down, test the mother bar's low, outside bar. It's the mother bar, and then goes right back up, but it's not able to get to the top. From here to here is a trap zone. It's keep testing the trap and not able to go above the outside bar's high. So that means there's no breakout to the upside. It's going to have to come down. It does. Now we have a bar, 51, broke the outside bar's low. You got to solid breakout, you can sell underneath that bar. You can put your stop right there, or you can find a 50% of this bar 47's range and put your stop there instead. And then you trail, goes down, and you're making money. You have a new lower high, move that stop above here. If this low is taken out, it does, and market gave you another boundary test. Look at the boundary line. And not able to come down to this half boundary line, and it just goes up, makes a double top, comes back here, and we actually closed around the EMA. And then after the close, I was actually waiting. I didn't leave. I wanted to buy, because why did I want to buy? We're testing the buy zone. We had Apple earnings came out. So I was waiting. I think it was around like 4:30 they released it. So I had to wait there 4:30. I never trade 4:30. There's nothing to trade. There's all machines. But it's earnings time. My day never ends until 4:45. I am going to ride that. Okay, big move, because Apple will move it, and they in fact did move it. And let me show you. That's that trading range. Okay, I was in this. This was really good, and I took profit right at the high, right before it actually reached that high. That was 1, 2, 3, 4 and I'm sorry, not that. Sorry, this one right here. I did not write that. So as it came up, I was out right there. I thought about get back in, and I was just so tired, and I can't do this anymore. This is literally, I jumped in with multiple contracts. I said, we're testing that low, and we're going to go up to that equal high. And most likely, I could have hold, but I don't have a big account to hold overnight, so I was not in this. I thought about coming back and buying again, but you don't know what will happen after hours, and you're tired. But this equal highs, I generally, when I see equal highs or equal lows, and if I'm selling into it, I will take profit before. If I'm buying into it, I will take profit before. And there was a huge gap there. So I was in this and I was out. And I'm watching this. I'm like, why am I not in it? This could have, look, it just went above that equal high, came back down, another flag. I regretted not trading this, but sometimes you just got to let go. You know, this kind of hurt me. You know, I could have tripled my account probably, but sometimes you just got to look at things from a distance and say, hey, I'm buying this, and that's it. Stop is so close, no white stop, no nothing, because it's the after hours. So my stop was literally like, I'm willing to lose, you know, a couple of points on this. I don't care. If I get a bull bar, I'm going to add more. I'm going to add more. So I got in, my stop is so tight, I don't care. I'm only willing to lose a very little if the Apple, I'm basically gambling here. It's like a lottery, right? So I get this big bull bar outside up, I load it up right there, and then it just goes right there. I said, I can take profit there, or I can wait for that gap to close. And right around there, I had an exit order, and that was done. It was good. But I would not recommend you to do this, because it's also triangle. If you're going to do it for fun. Test it out, okay? It just said that I'm in a buy zone, and probably buyers here. Market already proved buyers were there many occasions, and they want to break this, right? They're already broke it. Look, they're testing this boundary line. They're breaking, they're weakening this resistance, basically. And next time they come in, they're going to break it. So right now, market is at 41.12, and we are up here is 41.12. We're above this. It might, I'm going to get rid of this now. What can the market do today? Well, we're going to be above is yesterday's high. Okay, so we're going to be probably testing is what this Thursday, Wednesday's close. Market might be trying to get to the Wednesday's high. The only problem here is this. there are a ton of sellers waiting there, which we talked about. Selling began there. If we test this and not get above it, we might actually reject briefly, come down. And then if the bulls show up, okay, first I want to see what the market is going to do at this level, at the open. We're probably going to test it. This happens to be also March high. I'll put it there. There are too many lines here. I want to actually get rid of some, but all are very important at this point is because market has been respecting these levels. So I hesitated removing them, but open of the week is there. April high is magnet. May high is magnet. If market wants to go even higher, become bullish. April low, if we get rejected and we come down, I don't know if that's the case, but that's the April low. We are already above this important level. Okay. So there's a area of interest. Taking the bodies, as many as possible. I'll take that. Yeah, so this is the target for bulls. Only if they can is they're going to probably test, come down a little bit, and then we could go higher. Can today be a bullish day? Yeah, I mean, there are stops here. They're going to try to run these stops, and there's a gap here, the December 13 high. They might be trying to get there. Open of the week is magnet, right? So, so this is Thursday, Wednesday, Tuesday, and Monday high. Who knows, we might get there too. Okay. So when you see a strong bear trend, is market will 50% of the time at the open will try to get some kind of a continuation, which we talked about at the open, and that was your continuation. In fact, it was two-legged move. Some might say, hey, this is three-legged move. One, pullback. Two, not only push, or it was a pullback first, came down and closed here. So that bar on its own is a leg pullback and a leg at the same time, right? So, and then comes back down. That's the third leg. Some might argue that and say, hey, this is the lower low, double bottom major trend reversal. Then you're targeting right there. We targeted that, we targeted that, the open, and then we came down. So we're clearly in a trading range. We now have triangle. We broke out of the triangle. Market reversed, okay? And so we are above yesterday's high. We are already closing the gap. The only problem is that we are gapped up quite a bit here. So market needs to show us that if this is good average price to buy here and they don't want to come down, they need to show me bull bars closing on their highs, preferably consecutive bull bars with strong bull bodies. Okay, so let's see if we can get to that 41.18. News. Let me take a look. Employment situation came out. We have Lisa Cook scheduled. These are Fed members. James Bullard. These are all 1 p.m. Consumer credit comes out at 3. So I think we're going to get some, even at the end of the day, 3 o'clock, we might get some buy to close or sell to close kind of rally is at the end of the day with the consumer credit. Okay. All right. So the first part, it's trying to reach the 41.18 and a resistance above that it's trying to get to. March 6 high is breached. There's a gap here. Bulls are trying to test the body of bar 70. So they're trying to overlap a body right there at the minimum. But if they close this bar bullish, they can continue to go high. This is going to come down a little bit here, but it is trying to reach the 41.25.26 area. This bar is going to take profit, surely. Bar 1. Before going further high. But it is a big bar already. So they're pushing. They're trying to close this gap of bar 72. When a huge bear body overlaps with a really long wick, that's not closed. That's gap. That's gap is still open. Excuse me, I'm having a little coffee. Background. What happens when the gap doesn't close is we can come down and try to close some of this gap. There's a support here, but I have no reason that's done to think that it would come down. I have to wait for this bar to close first. I have to see the second bar. If the first bar 1 closes bullish, it could still go higher. Really strong resistance is up here. Okay, so somewhere around 35 to 36 area. Right there. Market is trying to reach here. Really? Okay. Before then, a 31 area. We might get a little bit, so I'm gonna get all of that in. Just about. Let's see. Good bar 1 is, I mean, we're above 20 EMA, so we'll probably want another bull bar. Again, is, anybody who wants to buy this, they're probably one tick above bar 1, waiting with a stop order. But it's big gap, right? So where would you put your stop if you bought this? Well, there's a moving average you would probably put there, but you're still at risk because all of this. So you have 2 bars, you take about 18 bars, okay, from the prior day to find your average price for bulls to consider buying if they think that this is too high to buy. It is too high to buy, but a second bull bar closing above bar 1, even if it's a doji, they might actually buy it, okay? So, but it has to be a tiny little body, or a doji would be perfect. Is something like this, in fact. Let me show you guys. Give me a second. Of course, I can't find what I'm looking for. Oh, they're here somewhere. This. Brad, are we? Yeah. No more picking on Brad about his. Let me take a sip of water. I sent him a picture of a camelback the skiers would wear. Comes with a little hose, goes into your mouth, right on your shoulder, so you could just sip water. I actually have one of those when I ski in Vermont. Oh my gosh, I guzzle that thing because I'm always out of breath and I need water. So I said, why don't you just get one of these? Do you want me to get one of these for you? Good thing he has sense of humor. Brad, he laughs at all of my nonsense jokes. But I know there's going to be a day coming that he'll be fed up and say, shut up, Rose. I'm just waiting for that day. And I was making fun of him. Next thing you know, yesterday, I'm in search of water. Suddenly, I can't talk. I'm like, oh, that's karma right there. So no more making fun of Brad. There's still buy orders above bar 1, but there's no acceleration. Now this is literally the last 20 seconds. Let's see if they can actually close this bar. They're about to activate the buy orders above it. What if this closes bearish last second with a micro double top? That would be a problematic for bulls, but they could still buy the next bar and get to my target. But that's good close. There you go. Nice, nice. Just trying to reach. They're trying to close trying to get to this. 26.25. Where inside is the resistance is trying to get to the area of interest. We might get a double top there, so watch out. That's approximately here. 36.50, 36. So we might actually test this area, but let's see what happens at 26.25. I want to see overlap with bar 70 body. And we don't have to stop here. If we actually start to close bull bars, we could go another 10 points, 20 points. March high is magnet. I think we're going to keep pushing towards the 41.42, which is above the March high, maybe even further more high into this area of interest. But I am more interested in the first sell-off from this triangle. I mean, I just put this haphazardly, but kind of got the idea. You don't really need it. All right, so target met is I would pay myself here if I were you, because we don't know if we're just gonna test it and have a wick. The bar hasn't closed yet. There's still 2 minutes, but suddenly it could collapse. I generally like to pay myself at these key levels. They're trying to get to here, eventually to the high. That's it. That one's tested too. So good bar. Trend from the open. Going towards the target area. 35, 36, possibly even 40, 41, 40, or even 41. So I would pay myself a little if you are with multiple contracts, and this is also a 3-bar measured move. So that's your measured move, initial. Some machines already started to take profit at this level, which is a close of 70, bar 70 from 2 days ago. You can see the upper wick. This is why I said you do want to pay yourself here, because you don't know if it could collapse. Probably not. They're probably going to buy the next pullback and continue to go higher. Hey, Tim. Tim is here. Tim Fairweather. I gotta tell you, as I say his last name, and nothing to make fun of your last name, although it's against my cultural norms. We do make fun of people's names, especially last names, because it's Turkish people. Our names have meanings, goes centuries, right? It goes all the way to Genghis Khan, all those Khans. So all the girls and the boys, we get names that describe our family or our characteristics, right? It's all that. There are some really funny names in Turkey. So we all make fun. I mean, it's just, you have to. So every time I say fair weather, I want to say, was the weather nice when you born? You know what I mean? Okay, finally I got it out of my system. It's Friday. We're going to have fun, right? Now that Tim is here with us, so we can have fun with him. Oh my gosh. Don't take it personal. It's the thing that the Turks do. So thanks to my mother and my parents, they were very careful picking my name. Oh, really? So she was doing the same? Oh my gosh. All right, so hopefully you guys actually took profit there. They might still buy. This pullback, it's very nice. Move up. And we have a measured move to the upside. And a resistance above. But this is why I like to pay myself, just in case, because I don't want to give back. You know, it's a really nice move up, especially if you buy above bar 1. It's kind of cutting into your reward there. Oh, really? There we go. I could be chocolate. Sure. Razzle dazzle. I like that. Actually, my Rose is a nickname, but it's the first syllable of my Turkish name, my legal name given. So it means rose, the first syllable, but it's actually Queen of Roses. Gusha is my name. It's a Persian name. I'm not Persian, but the language has Persian words. We have Western words and Persian words in our vocabulary. So it means actually Queen of Roses. So when you're addressing me, just okay, people. Here we go. They're trying to break this 2750, 41, 31, 25. That would be nice. It's a little bit more room to the upside. Come on, bulls. You could do it 50% of yesterday's, I'm sorry, 50% of last week's range midpoint. It's right there. Get rid of that. Get rid of this. So we would like to get there. It would be nice. Keep pushing. There's a breakout test area. So it's 41, 31, 25 or 41, 31, 50. It seems like a good place. That happens to be the measured move. First hour. Bullish so far. It's nice. Move towards the resistance area. Let's take a look at the gap up. Could we come down? That's quite a bit. And now we have gaps. Gap here. Bar gapping here. First pullback. We're probably going to buy. They did. Maybe we get something like that. And then go into sideways maybe. But we'll see. Market agreed that this is average price. So you can see that the EMA is trying to catch up. So it's right here when I measured that 20 bar range from some bars from yesterday and the new bars from today. I was right around here. So this one actually is reached. What if we just slam and come down? That will create a confusion in the market. That will not be good. But you see, we already have bar 4 closed above 2750, but the problem is that bar 3 didn't. They started to take profit there. And I warned you, but the market gave you another opportunity to take profits. So now can this continue go higher? It might, but this bar, taking out the bar 4 low, the only problem is there are probably buyers there disappointed that this is coming down too fast. So they're buying here to push the price back up. But if the bears close that bar as low as possible, they're probably going to buy because this is a tight channel. So the first bar breaking this, they might actually fade it and we might go back up. So, but it's always good to pay yourself just in case this collapses because it reached an area. It's an objective met. What was the objective? Objective was to close this gap. They not only close the gap, I said that bar 70 body is a big deal. They're going to probably try to close a body above it. They did. So bar 4 body closed. So that means is that right there is you know, bar 70 is a terrible follow through after bar 69 breakout. Mini bulls boy, okay, is wanting to go back up, right? So they got stuck, but that's an intentionally put in the market. Bar 70, what we call is an order block, okay? So it's intentionally put in the market by the institutions. So when the institutions target that, they target at the minimum that body, and they want to actually go test one tick above. And if they close it, that's a good news. But really, they have to actually get one tick above the high of that, okay, it's the entire bar to get their money back. But the body is more important, and the objective is accomplished. That's why I said maybe I move this line from the open to the close of 70. They're probably going to test that too, but just take profit. Now, measured move is a measured move. It could come down here first, right? So before going back up again. That means you give everything back. Why would you want to do that? Right? Plus, we're far away from the average price. It could still come down, give us a double bottom, and then decides to go high, swing high. But then again, you would lose a lot. So better to pay yourself. Swings can, you know, fatally decimate, and then you lose everything, and you wonder, wait a minute, this was a great trend. What just happened? You know, it's coming down. Let me get this out of the way. It's coming down to the bar 1 high. Probably there were sellers there thinking this is such a big gap, and it's testing this area that sold before. So they're thinking, hey, sell here. If they sold and disappointed, they're going to sell 5-10 points above, okay, so where they sold. That's just about 5 points, right? More than 5, but I'm just saying, you know, 5 points is they can come down and break even. So if you actually sold there, you are at your break even. They're even making money now. As it comes down to bar 1, is they're going to be, as soon as it tests the bar 1 high, that means they actually not only close that gap and test the originally where they might have sold, is because 2 actually did come down before closing high, they actually make money. So that right there is break even. I mean, there are always gaps there, Ervan. You don't know is, you know, which ones you can always target them, but first you target this, right? It's the first one, and that's a big one, 72. So you have to is, you know, you cannot assume it's going to keep going and going and going with such momentum. All right, so you have to expect those pullbacks because objective met, and the machines have to take a breather, you know, pay themselves, and it will be better to buy a pullback again. So we have a tight channel like that. First breakout will be challenged, but it is a bar 5 is a really, really nice size bear body. Probably wants its second leg down. The only problem here is that when you have something like this, there's stock bulls there. What they do is they buy also. Okay, so maybe a 1 or 2 point below, they're going to buy. They're going to look for a break even, but eventually they want to get up here. Now, before they get up here, we might make that a second leg down. So this is high 1 now. So we might look for the high 2 and then go higher again, but we don't know that. is, I'm going to get rid of this now. Market is still trying to go higher, but bar 5 is big. There's still gap here. It's bull gap. Bulls are trying to maintain it. So they shouldn't allow bears to print a follow-through bear bar. If they do, we will come down and close this gap like this. Get a second leg here, and then we continue to go high. We have a nice bull flag here. This is a bull flag on its own. And then we go for a third push. We do a deep pullback. But if we maintain this rather large gap to the EMA, we might keep buying this all the way to bar 50 and then come down. So there's that possibility. Or so far, we're trying to see how they faded that bear bar, but that bear bar is not as strong as this one. So this will try to get a second leg eventually. Bulls are trying to get back to the high, just like they did here, but they couldn't maintain and then came down. This bar, you see this, now how would you sell this? In order to sell this, expect market to go higher a little bit more. Up, down is up, down, and a third push up. So we need that third push, okay? And then if we start to come down and we get multiple consecutive bear bars, bear bodies, and one of them is a gapping down, that creates a bear flag opportunity, and that could sell with a couple of legs down like it did here. But if you start to get a mixed bag of bunch of alternating bars, bear bar, bull bar, bear bar, maybe a small, that's not going to make a gap. I'm sorry, that's not going to make a bear flag. Don't expect it. What it's going to do is it's going to try to get back up to high, maybe make a new high, and it is possible. All right, so we just took out the high. So the market is still trying to climb. Actually, the target is now at 41.3825, which is right around here. Like, for example, here, you didn't get that gap bar, but you got a slew of, streak of bear bars. That still creates that double top, lower high bear flag. When you get those consecutive streak of bear bars in a nice, in a row like that, that's still expect a bear flag and try to sell and test the open. Okay? Like here is, you don't get that. This is the alternating bars I'm talking about. You get these alternating bars, don't be so quick to sell because we're going to go back and test the high. Sometimes we test the high, one tick, we trap the bulls, and then we come down. Double top, neckline, stops are here. Bears can run those stops and we get to the open of the day once again. Or we break with a bull bar and we keep continuing, and the gap to the EMA would stay open until bar 35, 39, 40 midday reversal. So we have a really nice, healthy, climactic channel here. That's a V-shaped reversal in a way. This one kept going and then made a micro wedge top, came down, spike channel, tested, spike pullback in channel, the pullback bar, that bear bar low, but couldn't find bulls, and then a bear bar means sell to the 50% of this leg at least. Okay. So it's still trying to make that wedge top. And take that. Didn't really tested it yet, but bulls need to close this bar bullish. They want to keep going, but we are testing somewhat of. We're very close to the resistance. Bears want to test the inside bar 6 low, but I think they already bought above it because it's high one. They bought above it. So or you could say high one, high two, is they're still trying to go higher with the stop underneath 6 or 5. I would put it under 5. Goal is to get to 41.3475 or 38.25 or 38 area. They're getting some kind of a wedge here, although I'm not so sure. If you don't count 2 as a pullback, then you have a first leg pullback, second leg, we might go pullback, we might make the third leg before coming down. Well, take a look at, no, I said bar 1 is bar 4, and whatever the next high, we're still pushing. That's because 2 is kind of a pullback. So I'm looking for wedges. But if this is a one big leg, then you have a pullback. That's the first pullback. We haven't even made the second pullback. So this is going to keep going up to my targets. I don't see a sell signal bar. There's nothing to sell here. Like I said, bulls will probably going to buy the first and fade the first bear bar, even though it was nice. But look, bar 6 is a high open, closed above. So now you have buyers probably going to buy that bar. Stop orders were above 4. They got filled, so they're making money. Limit order bulls bought the first bear bar they saw, so they're making money. So he wants to go to places. Okay. Here's 36.50. We should be able to test it, hopefully. I like to see more towards 43.45 area. This area, push. But we're in a resistance now. It's got a little bit more room to the upside. I like to see bulls push this. Is on the hourly, you got a really nice bar testing the 50% of last week's mid-range. So it is okay for bulls to actually take profit because it's also a breakout test area. So we know there are some sellers there. 50 SMA, I'm sorry, that's an EMA. 50 EMA is magnet, so they could keep pushing towards that. Some machines will pay themselves here a little bit because look, like I said, bar 70 high is now magnet. I'm just gonna, let me see if I can, this is what they're trying to tag. In fact, it's one tick above. They're trying to tag so institutions can get all the money they threw in the market to trap the bulls for buying. They take that money back now. So I like to see continuation into 41.36.37 area. Beautiful bullish open. But we will come down eventually, and we will first come down to 41.14.15 area. Might test even further down 41.08. I don't know if we would actually pull all the way down to 40.97. Here, they have to create some kind of a like to close this gap. I need to see some kind of a double top, some failures, or wedge top and a double top after that, lower high. So right now it's bullish, keep going. 41.40 is my target. Yup. I even shined it, dusted it and shined it before the session. So I have a clear view. I did say we're probably going to test one tick above 34.75. That right there is no joke. So it's big objective. So all these institutions invested in their money to trap traders or other institutions got their money back. Now, look at the size of this body, slightly almost as the same as the biggest body, which is bar 3. It's actually not as big, so I'll take it back. They couldn't close above 34.75, but they did get their money back, so objective met. This is a bit of a resistance here. I will be careful, even if it drifts up a little bit, because it's a big bar. It's a follow through after a breakout bar 7, but soon we're going to trap these bulls as they start to take profit. They're looking for a bear bar to even initiate any profit taken. So I'd like to see bulls give us a couple more bars, drifting this further up. But any sign of a sell signal bar, they can exit out underneath a strong bear bar very quickly. But there's a little bit of room to the upside. Oh, that's not good. So they're already taking profit. But that's institutions, because they made their money back. So they might be taking profit. Now, this could be just a second pullback before we make the third push up. Big gap to the EMA. That is a kind of potential problem. And there were sellers here. Look at it. Above bar 3, they started to sell. So market wants to get back to the bar 5 high, and it might pull back. But first we need a bear bar to even initiate or scare the bulls out of their positions. Without that, no one's going to sell. But it is very climactic. And, how far can this go? Like I said, it's trying to get to the 36.25. Doesn't need to stop there. It might actually test 39 to 40 area. But I'm willing to take profit at 38.25 or 38. So I'm going to see if we can get that 38. But it's pretty high. And I think we're going to come down a little bit, at least 5 points or so, maybe 10 points. Anybody who sold here is probably wanting to sell high. And they might, so already that's 5 points right there. So they want to bring the market down, or they're going to sell around 10 points. That's why I said it might actually go to 38. Is that 10 point? Yeah. So that's 38.50 is, yeah, in that vicinity. 38.25 I said, and I settled down on the 38. So this is a room to the upside. A little bit more. Come on. Wait, there's an app. There's a crystal ball app. How do I not know that? What's that app about? Now I'm curious. Bears are going to show up soon. So this is just trying to get some continuation. Oh, wait. You'll be also respected in the hip-hop community. Ooh, Queen of Bars. How about Mother of Bars? That's kind of sound dirty, but your Mother of Bars. Now, I'm going with that only because I have the Mother Bar technique. No pun intended. But I like the Queen of Bars. And, all my ties in the hip-hop community. We can't forget that. And I gotta watch my reputation on the street. The streets. Okay, this is not going anywhere. I'm gonna stop this now. It's going somewhere, but I don't want to go there. Okay, keep going, bulls. We want to go a little bit higher. Okay, so that's a profit-taking bar right there. It's an inside bar. I like to see bulls push a little bit more to the upsides. Bulls push a little bit more to the upsides. And not take out the low of 9. Give us a high one. They've been buying the high ones so far, which is great, right? High one, high one, high one. So, but if we do take out the low, it can come down. I just don't want to exit out. I don't want to be shaken out of my position here. But there are sell stop sellers. Okay, bears underneath is bar 9 positioned already. And they want to get 2 point, 4 point, 5 point, and 10 point to the downside. If we cannot take out the high here. That's my cultural 1986. We turn everything into a joke, something to laugh about. It's, you know, when people have hardship as a culture, you know, whether it's economical, Turkish people known for their great sense of humor. We'll turn everything into a joke, something to laugh about and forget about the hardship. So it's in the blood. Keep going. And Americans are that way too. I don't know if you're an American, but American people are great sense of humor. We're just easy on things, you know, we don't take it very seriously. We do, but, you know, with what's happening in the world last couple of years. Bulls are still trying to, okay, so they got it, one tick above that, but is this going to be a trap now? If this bar, okay, so there's last half of the bar, longevity, 2 minutes and 19 seconds left. If it accelerates to become a bear bar, there will be sell orders waiting underneath. But the problem here is that I don't want to sell. Even though there's a huge gap here, there are probably buyers at the 50% of bar 8 waiting to buy. I've got a target up there. I want to see 41.38 tested. So I am just not going to let this go. Until they show me that, I should let it go. The 36.50 is right there. We have not tested. We're so close. There is they're trying to make this bar bearish last minute before it closes, but I am not interested in selling or exiting my long unless they take out the low. There are probably buyers there underneath waiting. And there are also sellers there looking for a double top trap and midpoint, but who's going to sell against 8? Bulls need to be trapped somewhere. They have not been trapped yet. It is getting there. We will pull back. You can be sure of that. I just want to see it set up. I don't see, okay, so bulls can actually now continue to go higher. What I don't see here is that bears making money underneath bars. When I don't see that, there's no selling, right? So it's up and up and up. We're making small higher lows. Now we're making higher highs, right? No, I mean, bears try to make money here. They failed utterly. So they're selling 10 point. They try to sell 5 point above, failed. Then they might actually wait for a price to get to the 10 point and sell around there to bring the price back down to the bar 5 high. Good luck with that. It'll come down, but I'm just not ready to do that right now. I need to see the bears making money underneath bars first. Then I would be interested. Otherwise, it's nothing but blue skies and high altitude. It is getting a little bit high though. I do have to, you know, mention that. But the 38 is still target 41.38. All right, 36.50 tested. Yay. Are we breaking this resistance right here? Sure. I don't think so. Let's go. Maybe we do. We need a good bear signal bar. Like an upside down pin bar with a nice bear body. It's still bullish. It can make you sell, and then it keeps going. But any bear signal bar would be ideal. Okay, so that's a nice one if they can close it that way. You got you got an inside bar. Bulls tested above the mother bar 8 high and trapped. But do the bears have it in them to close this gap and test the bar 5 high? Now, it's in the vicinity, but not necessarily the 10 point. They could still go higher if the gap stays open. We're testing the midpoint of the bar 8. There might be some buyers there, but the bears want to test the low of bar 8, okay? They want to test and see what's there. Bulls want to keep the gap open. So just wait. If the bar closes bearish, sure, then it becomes an outside down bar. You can sell. But if it doesn't last minute, then the bull gap stays open. We could keep going higher. But this is resistance here. I like to see actually bears get it together and sell this. At least to get closer to the bar 5 high, because these bears are desperate. They want at least price to come down midway. Okay. It already did. Others will probably sell that. So they're getting a break even. So that right there, I like to see it test it. Okay, so excellent. Sell stop orders activated. Bears started to make some money. So I want to see the test of, I did sell now as it breached the bar 10 low and then this. So I want to see a little bit more continuation. The body has to close below is the midpoint of bar 8. If it fails, I'm going to exit because it can still go higher. The body has to close below is the midpoint of bar 8. If it fails, I'm going to exit because it can still go higher. Yeah, they did close it. So let's see. Bears can get a follow-through bar. But if it fails, we go up. But it's an outside down bar. I like to see continuation down. Maybe 28.75, 29 area would be nice. We might test that and then bounce before coming all the way down. Oh no, it is right there. So yeah, that would be nice if they can actually push this through. If this bar does not close bearish, you should get out because it could go higher, at least 4 points or 8 points. But it is an outside down bar. It's trying to get a continuation second leg, or at least a couple of bars. To me, this is high 1, but if you count from here, high 1, high 2, and it's high 3. Like I said, this could have been a wedge because this is a pullback and buy, second pullback, third pullback, okay? Second pullback, third pullback, okay? bears are trying to get continuation towards the bear bar 5 high, but it's difficult because bears did not really move the market as strong as, actually they did, I'm sorry. If they actually close this body right here, bar 11, they can easily come down to 41.2675. But if this body fails, bar 11, and if it doesn't close, and I'll tell you exactly where, 30.75. If we do not close a bear body 30.75 or below, preferably below, this could go right back up. So be aware. That's why this is important. A follow through or failed follow through, it can make it or break it. But since it's an outside down bar and the body closed pretty nice, I would assume bears are going to try to get some kind of a follow through. But it is so important that they close a bear body. If they fail, I'm actually buy it again. See, it didn't close, is bearish. That's a problem for bears now. So now they're nervous because their stop is probably there, and they're going to try to get a second leg down, at least a break even if they have sold a close of bar 11 or sold underneath 10 or 9. Bulls are keeping the gaps open because they want to see 38.25 tested. That's terrible for bears, and this is why but there's possible second leg that they still want. That's another high one. But to me, it's actually a complex high too. This is high one, even though this one above, that's a pullback rally. Now the second rally. Okay, so here is buying above 12 is basically, to me, a variation of high two. So they want the 38.25 still, or 38. I'm just going to round it to 38. See if they can actually get that. Or the breakout test, 38.75. Very disappointed. It sold here, maybe sold one tick underneath that outside down bar because 12 breached that low. They're most likely to sell at the high to get that second leg and break even. But or they're going to sell higher, because if this is the second pullback, then the bulls want a third push up, and they may not actually sell before market gets up to here. Just waiting for 38 or 38.25 to be tested. We do not need to stop there. We could go another 5 or 6 points or 10 points above. I would say probably 5 to 6 points, and we might end up testing 41.43. But I'm more interested in 38 because that's where I want to see tested. See, the bears are already selling with limit to get a break even. Could it start a double top neckline is 12? Can the bears actually trap and start to sell and run the stops underneath 12? They could, but first they have to trap Nothing to sell yet here. It's a really nice, strong bar here. We just need bulls to just finish this job. Want to see 38 to 38.25 tested. What a boring morning. It's just going. Nothing exciting happening here. Making money is boring. That's how it's supposed to be. All right, there it is. 38. Oh, 38.25. Target met. These little Pac-Mans. And then they get a big one. And that's it. That's profit taking right there. I hope you guys paid yourselves. But it can still go higher unless they trap the bulls here, because it is the wedge top. And bears need a trap of bulls and a strong bear close. Then they would sell underneath a bear bar. This is just profit taking, initial profit taking with that upper wick. It could still go higher. This is the objective area of interest. Oh, sure. There's, yeah. So it could just, yep, keep going. Yours is 40. Yeah, you could take that too. But since we have a leg here, is measured move. Since this is leg 1, leg 2, leg 3 is almost as big as, always expect leg 3 almost as big as leg 1 is, so it might actually keep going higher. I paid myself, you know, I want to see if we're going to come down a little bit. This bar closes like this, we could continue to go higher. So the target is 41, 43.25, and a little bit more above. March high is magnet, obviously. Post your charts. Don't be shy. No one's judging you. It's best way to learn. That's why we have the Discord. You see something, say something, right? So how did you find your 41.40 potential measured move, for example? Just post a chart. Let's see. Beautiful close. There's nobody's trapped there. It's still going. So it's looking for a 5 to 6 point. So that would be 38.25. Add about 5 points to that, or 6 points to that, right? So it could still get us to 44.25 or even 45. Bulls are in a really nice move up here, but it is getting climactic, and it is going to come down. All right, magnet met. Now we have third leg. See if the third leg can actually finish this job, and we can test my area of interest. Now, why is this area of interest important? We can actually test the, did I do a good job there? Oh, I obviously botched that one. And take that, perhaps. So we could go a little bit higher, but you can see it's trying to go 5 to 6 points. You could test in the middle of the area of interest, give or take. So that's why I put it somewhere in the middle before coming down. Or you could just test here, come down, measured move there. But let's see. Pullback buyers are at the breakout point of 14 and 13. They're going to try to buy there, but it's been going steadily. Bears need some kind of a reason to sell this. But there are probably buyers here. There's sellers here. So bears want to close this first gap and test a high of 11. That's why there's also buyers probably there, like a 36.75, 37 area. But if the bears close a strong bar here, that could become a 2-bar reversal and suddenly we could get a leg or two down into here. If they close it bearish enough. This I don't care anymore. Pulling these up so you can see. This is support. There are probably buyers here. Depending on where this body closes. Some buyers showed up at 36.75 or 37 area, which is the breakout point, I think. I'm not sure. Yeah, okay, 36.25. Even tested 36. So that's a bounce. They're making money with limit order buying there, but if it becomes just a scalp and this bar closes bearish, we could get a leg one, leg two into this area. Abundant baby. Who comes up with these words? It's a baby abundant there. Cool. Well, we already made 40 points. So market is taking profit there, bulls taking profit there. Is taking profit there, bulls taking profit there. I've been counting, believe me. All those targets are coming with counting. So if you actually go here, right? Let me check this. Yeah. So then it's from here. 40 points. 38.25 was that 40 point. They can get to 45 or 46 and possibly fail. But if this pullback, they find buyers and fail to get a 9 point, then we could go up to the 50. That's where I measured from this bar, not all the way down because it was a bear bar. Bulls did show up right there with that bull bar. So I started to count where they showed up. There's a gap here, so I'm going to take that gap as well into consideration if we do fall back. Probably buyers around is bar 12 or is a little bit below, waiting. Bears trying to get back to, and they did actually. So they did test the 11 high, but this is left behind. So bears need to show us that they can close gaps, and there's a gap here that they haven't closed. This gap stays open, we continue to go higher. This is a really nice trend, but we have a wedge top now, up, up, and up. So market wants to take out the 15 low, and they want to come down and test this area. We might get a 2 legs down now that we have 2 bars. It's an outside bar, inside bar. So bears want to test the bar 15 low and see if they can get a breakout from there. But the bulls want to continue to going higher. We might need to come down one more time and trap the bears and to go higher possibly. Bulls have more room to the upsides, somewhere around 41.50. Like I said, they want to keep going higher. So you're inside of this bar 15's range. And the 16 might have just hit the trap zone, but we might need a second leg maybe, since we have 2 bear bars. It's the first time bears are putting consecutive bear bars. They might want that second leg, even if it's a failure. So it's a small trading range. It's also a triangle. Bulls want to break out. There are probably limit order sellers above 16. Disappointed. So they want their second leg down. It could be 2 legs though. Doesn't have to be a 1 big leg. It could be a combination of 2 legs, okay? So we might get there. But this is it's kind of a small pullback bull trend, but pullbacks are 1 or 2 bars, so the bulls are buying. So I'm looking for reasons to continue in the direction, but we're getting a little bit exhausted because of the 3 push wedge top, and now we have 2 consecutive bars, so we might get that second leg. I like to see continuation higher and get a 20 bar gap to the EMA, which would then give us first touch of EMA buyers could show up. Bulls are maintaining their positions, keeping the market bullish with gaps still open. If you actually go to the line chart, see a huge gap. So we have quite a bit of gap here with an area they still want to test. But since we have 2 consecutive bars, I like to see bears use this pullback and give us a second leg down. Okay, so if the bears actually close a bar, and I'll tell you right now, it's 35.75, they can bring the market down to 32.75 area. It is possible that we might even test 31.75. So pay extra attention to where a bear body will close with the second bear leg down. I would like to see a bear body closing at 35.75 and not fail as a second leg. Then bears can actually sell with a third leg down. But if they fail, and this is a second leg, it breached below the 17 pullback bars low, so technically it is a second leg. And if it fails, we could end up going up here, and that would give us that third leg, that almost as large as the first leg. So I'm seeing this on the line chart. Okay, so it's a gap here. Gap here. Okay, gap. Okay, so if you look at again, make it see the gap right there? See the gap? Look at the 16 to 10 high or 11, whatever that bar is. As long as these gaps are open, market wants to test the prior high and break above them. So that means we're in a very bullish market. This is still the second leg down. It might, and trading range might have started with this bar already. So that's why I put this zone here. We might come down and test it, but first we have to take out this with a bear close. Okay, if the bears close a bear bar below that, 1 tick below that, is expect. So I sold the pullback and I'm selling the second leg already scalped at the 35.75 is if they do close it, I have a runner into 32.75. So I want to see if I can actually get that. Unless bears fail here, fail to close a bear bar, then they may not be able to come down, but they probably will. We might get a third leg down, in fact, have a wedge bull flag and go higher, go higher. Okay, so is the moment this bar closes, and it doesn't have to close, it could just go straight down to 32.75 to 31.75 area. So my runner is running. Okay, so my I'm going to put my stop to break even, which is here. I move the stop to here in case it fails. So I don't lose anything. I make an extra tick with that runner and walk away with tiny little win, but nothing would be taken out. So that's the game. Just waiting for bears to push this down a little bit further, at least close that body as bare as possible. Accelerate it is try to close this gap, maybe test of bar 12 high, but that's not enough for me. I like to see is at the minimum 32.75 tested, but failure to close that bear bar with bar 18, we could end up going back up again. There's no always in short, we're always in long. There's nothing here that is alerting me always in short. I'm just scalping because there's a wedge here, 1, 2, 3. And see, they failed, but here, I exited out. I didn't like that. I didn't like the fact that bar 18 did not close, so I took my money. Now, it could still close a bear bar, and there are probably sellers underneath, and they're wanting to get down here. But at this point, market is always in long, and we tested the bar 11 high. Closed a bear bar, but it didn't close where I needed it to close. If I see a bear bar close here, I might jump in again, but we're bullish, so I'm not interested anymore. I'm just scalping the exhaustion from magnet and expected 2 legs down after 2 consecutive bear bars with a pullback 17. So I sold above 16 and with 2 contracts, in fact, scalped the first contract runner didn't run. It was running, it was still green. I made money with that, but I voluntarily exited because bar 18 didn't meet my criteria. See, if I didn't exit voluntarily because it didn't meet my criteria, it would have ran my stop right there. Can we get a double top, maybe a higher high or lower high, and then come down? Oh yeah, we could. This is a high too, but I don't like buying above bars like 18. It's a very strong bear bar. So if you buy, it may not even make a 1 point. There's that probability. So I didn't buy above 18. See, that was a good decision on my end because it's still always in long, still pushing towards that area of interest, still pushing towards the prior high, 15 high, and bulls can still take that out. This is still a strong bull trend after all. So here are some bull trends, right? pullbacks is weak and gaps are open, and we're taking the highs out, and from that high is to the pullback low, there's a gap. From that high, even that test with a week did not close it. So this is what we have at the moment. Okay, so yeah, this is what we have. This is, you got deep pullbacks. That's not us. Both sides of the market is making money. They're closing the gaps some ways. So therefore, prior highs are always target. Machines will buy here. I don't like to buy, but you can perhaps buy this bar, 19, because there's a bit of a void here that makes it slightly stop order market. But it's just so high that suddenly if it collapses, because we have a trading range here, that you should have been in your trade already, so your stop here, now you're looking for this high to be breached to move the stop underneath 18. I'm flat because this is resistance and this is a small trading range. They're probably we're gonna come down and test. There are probably buyers there, and there are probably sellers above. So that's why I don't like to buy above bear bars, even if it's a high 2 setup. Market is still trying to go higher, and it might continue. It's trying to get to 2 days ago, right? So it's, what is it? Wednesday's high. Wants to test the Wednesday's high. Or the open. We're already testing the open, I think. So it's a little bit difficult. It could sell suddenly, and I don't want to. Market is looking for trend reversal. Neckline 18. Bears know that there's stops under 18, and they want to run those stops. So if you count from here, this is the first sell. Bears want a second sell, and this is why I didn't want to sell. I'm sorry, I didn't want to buy. So market's trying to come down here. Possible wedge it's trying to make. See what I mean? Why I didn't want to buy above 18? Target is 31.75 for bears. 32.75 to 31.75. If they can actually get that. They might even go further down a little bit, since this is the support. Buyers are here. Outside down bar, but it's up, down, up, down, up. So there's a possible wedge there, but it's a big bar, so it's probably going to try to get a second leg down. I'm going to scalp to 31.75 if it gives me. I already sold. Instead of buying, I sold. I kind of anticipated this to, happen. So it is happening. I just want to test. I just want this to test the 31.75. It came down one tick close and it didn't. So I didn't really cash in here. It's probably going to test the 31.25 or 31 area, maybe even lower. So it should fill me on the way down. Can it fail? It is the wedge, and the bulls want a flag here. 1, 2, and 3. If it fails, it's because people bought above 19, buying down here. It did test after all. Okay. Test the zone to the tick. So I was accurate there, but I didn't make money. So now I'm going to sell again. I'm going to sell again. And I'm going to break even. If the spark closes bullish. So this was accurate. It did come down to 32.75, even further down, but it was a one-tick failure testing the 10-point. But they got 9.75. Oh, sorry, that was 10 points. What am I talking about? No, that's 9.75. It cannot be 10 points because I didn't get filled. So that one tick greed got me. One tick greed. I generally take profits one tick above or below, but this time I literally positioned there. But that's okay. So 50% of the SPAR problem limit sellers also disappointed selling there, wanting to break even. Well, think about, are you asking why bar 15 is a mother bar? Is that what you're asking? You mean, or why am I not measuring the bar 15? I mean, I'm reading the bars. You can do it yourself as well. But if you're curious, since you say out of curiosity, okay, so you can add. Target met happened to be 10-point zone, so actually went below it, and then just it's trying to get back up here and eliminate this because bulls see a flag, they want to test that and use this as a target and that and that. So yeah, they're trying to trap the bears. But you know, bears are upset because it's a really nice bar. They sold underneath 20, and they're probably gonna, since this limit order, they're gonna sell at these highs or any strong bear bar close. I'm sorry, bull bar close. They're gonna try to sell it. In a limit order market, strong bull bars, bears will sell. Strong bear bars, bulls will buy. Okay, so that's a limit order market characteristics and behavior. So that's it. You see how they're selling the close of that bar to try and break even? But really bad is, you know, price action here. Nothing is very bearish to begin with. So bulls just, you know, bears are making money, but bulls want to continue to go higher and test the highs. On the hourly, I said I still see a room to the upside, but we're in a sell zone and we're testing the area of interest. So if bears can get another bear bar here, that'd be nice, but that's because they want to fix, they're stuck here. So they want at least market to come down to here if possible. But no consecutive bear bars. So you're selling with a limit order because this is kind of a limit order market, but the bulls still want to buy and get back up here. So high one is bad high two. So this is a much better high two. But first the bears need to exit out. So, okay, so I broke even and kept the contract and looking for bears to come down and test one tick below where the stop order bears entered. So the low of 20. I sold that close and broke even, and now I have a runner to see if I can maximize by exploiting this situation. Such an exploiter. Come on, bears. Come down and fix this mess that you created. Well, it's because I mean, anybody who's waiting to enter above it didn't get filled. It's bad because of the situation. Okay, there are a ton of bears are upset, so they're gonna try to sell it. And when somebody sees a bar like this, they're gonna wonder, oh, okay, maybe I shouldn't buy. Maybe I should sell. Okay, so now I made money. It's coming back to the original price where I wanted the scalp in the first place, which was the 10 point. That was 31.75. Now let's see if they can actually test that and give these bears their actual planned target. It came down and tested again, one tick above 32, still no 31.75. But you see that worked out very well to my advantage. And if this is a bull flag, what's happening? Where are the bulls? Now, if we can get a micro double bottom and in 20 seconds this bar goes and closes as bullish as possible, that's a chance that we might still go. But what is going on here? Who's going to buy this bar? Unless some limit bulls will buy the close. But this is where I wonder. That's a micro double bottom. Some machines will buy the close because it's still a limit order market, but bulls are upset. This should not have happened to a bar like this. If you are still looking to buy, I mean, do you still want to buy? Your order is still up there, sitting. Market could come down to the EMA. It's the second test of the zone. So I'm going to wait to see if bulls can actually show me a decent setup. And then I'll look to buy, but otherwise. We might move underneath the EMA. Bears get a low too, if you're counting, right? First, second sell, they fail, they have to fix it. Bulls have to fix their second buy. It's a mess in here. Maybe it's best that you wait. There's a really nice buy zone around like 31 to 28 area. That's right here. I like to see market come down and really test inside of it before I do anything. Confusion, hallmark of trading range. Yes, I mean, look at the confusion. You can make money with limit order buy and sell. You just have to identify the conditions like I did. You can get out of any situation. You can make money. I'm very excited about scalping. I love scalping. It's just I can build a really good account. Okay, so a P&L, scalping and then catching a good swing trade. We already had a swing from the open. So now you have a wedge here, but it's kind of difficult there. So I'm just going to wait a little bit. Here's a weekly bar. Okay. Where bulls wanted to get above this and get up here. And we're smack in the middle of the week. We have expanding triangle. Therefore, this is a bull flag. We're right at the apex of it. Okay, so they might be wanting to close this week somewhere down here just to throw us off a little bit. So 4,100. I don't know if I can bring it down. Or we're going to close this week as bullish as possible with a micro double bottom at the EMA. And then we just break above this. Okay. And if we do break above it, we go right up here, which is a wedge. 1, 2, 3. So bears are trying to prevent the measured move up on the daily. So they're trying to make this as bearish as possible, but there are bulls who bought here, okay, trying to make money. Bears who sold here, upset, they're looking to sell. So it's a bit of a difficult, and we have a 20-bar gap here, so all I know is that there are probably buyers waiting at the EMA. The first touch will buy. So I want to buy. It's inside bar. It's in fact inside, right? So it's a breakout mode. It's all II. 21 is O. 22 is inside. It's an O itself, but it's also I. 23 is I. Okay. So the bulls want to test the bar 21 high. We're smacked in the middle of it, 50%. Bears want to come down and break out from the low. Still sideways. But since market is up, bullish, I would assume bulls are going to try to get us back up, because this is not a really good bear. It's just a trading range. However, if the bears are seeing some kind of a head and shoulders, a little bit lopsided, okay, this is the neckline. So that means they want to break this, get back up, and sell again. We're still always in long. We're just in a trading range. It's also a triangle. Okay. You can either take it that way, or it's much better. So we have we're probably going to test here and then go back and test there, and then we're going to break out from somewhere. Trading ranges, triangles are 50-50, breakout up or down. But since we're bullish and this area is a much better trap zone, I don't want to sell. I already fixed my bad trade, and it gave me more than what I bargained for. And I think we need to test this right here. So I put a buy order above 23, and I'm looking for close. Test of right there. See if we could do that. Just about 39. I scalped a little bit above as it went my way. So that was a 1.25. So I grabbed the 1 point there, and I have a runner. Looking for is first the 36 and then a breakout. 36 and then a breakout. Bulls are targeting 41.42. Here-ish. So you can just copy this. Oops. Oops. These are the levels. But this is the most important from here to there. Okay, we just tested the 39, like I said we would. So I want to see bulls continue, but we could also collapse. But 2 bull bars, I like to see is, breakout continuation. At least a test of 41 or 42. don't think this bull trend is done. I think we might need to thoroughly test the 50 SMA, above the 50 SMA, or at least make a double top with this hour's high. I would prefer bulls to actually test above the last hour's high and not let bears sell here. We did not touch the EMA yet, and I'm warning you, we may not actually test this EMA all the way to bar 35, 39, maybe 40, maybe even 42. I'd say 38, 39 to 42, 4 bars. So we might keep going higher and higher and then come down to the EMA. Gap is still open, but this gap is closed. Although there's a little bit, no, actually there's a gap here that they left open. So that's why we're still bullish. That's another reason why we might still go higher. Bears actually failed to close this gap. Some might argue that this is closed, but I don't like it when the gap bodies are not overlapping. That means it's still open. That makes it still bullish. Yes, I did already say it. I don't know, Nate, are you in the, you're probably not in the room. So if you haven't heard me say it like, I don't know, 5 times that this is a bull flag, possible. So if I say it, you're probably not going to hear it anyway. $41, $41, and $41, $42 is still targets for bulls. And then furthermore, $42, $50, $44, $50 possibly. So I want to see continuation unless I get surprised. We get a double top and a reversal, major trend reversal. But it's just such a mess here. Beautiful bar 24. Bulls want to test this high. Get a measured move. We get an area of interest. Okay, still up there. Still no breakout from that upper trend line. So it's a fair game. We might still come down and test this lower trend line. But suddenly we get a nice breakout. The only problem here is that it's a gap down already, this body at the open, slightly like a tick gap down. I took profit at 39. I have a runner, but I'm also prepared to buy again in this trading range somewhere here. I want to see market test here, and if they're going to sell, there's a better place up here to trap the bulls. So what it's doing right now, okay, I would like it to go like that and then trap and come down. That's fine, but I don't want to sell right now and trap and come down. That's fine, but I don't want to sell right now. We're about to test the apex. So bears want to come down and test here. There are buyers in around 41, 31 to 28 area. So they might actually breach, get a fake breakout and test this area and go up. If bears close this bar bearish, we could come down here, do a quick test, break of the trend line, and then still go higher. Still always in long. It's only been 26 bars. Okay, so this hour is new, and I like this hour to actually test the high of the prior hour and above the 50 SMA. But that's fine. It would be nice if we can actually trap the bears and then go higher. This could be too high to buy, but because the gaps are still open, it's still a bullish market. We'll still control this. but if anybody who is entering here might be entering too high. So it's better for, let this come down to a key level, is buy the pullback rather than buying here, because the moment you buy, it could collapse, and then you either are forced to buy again, or or it could start to sell. The only problem with that is that this is messy, and every time bears try to sell it, bulls actually both those pullbacks. So it's difficult to sell as well. Buyers are here. We need 3 touches, okay? Or is 2 lower highs and 2 higher lows before the triangle breaks out. So we made 2 lower highs, but only 1 higher low. So it would be better if market sells it all the way here, and then we trap and then go again. So I think we're going to be testing 41.31, 41.31.25 area. Oh, I think, never mind. I froze one of my charts. How did I do that? Oh, it came back, okay. In the middle of a trade, and then things froze. It's like a heart attack. On a Friday. Trade, and then things froze. It's like a heart attack. On a Friday. Okay, here we go. That's the second higher low. We might actually test a 22 low. Love to see 31.25 tested. We're gonna squeeze out or squeeze out to upside or downside. I like to see this tested. We're so close to the EMA, but we may not close that EMA. So be careful. Bulls want to keep that EMA open, even if it's a 1 tick. Wedge, 1, 2, 3, double top, lower high. Bears want a major trend reversal. They want to take out the stops underneath 22, but it just needs to accelerate. 20 bar to the EMA, gapping. First touch, could buy. Be careful, is we can literally touch that and then bounce. Their buyers be somewhere around 41.31 to 41.28 is waiting. Bears want to run those stops. EMA is right there. It's actually higher than the 31.25, so 31.50 we might touch. If we fall underneath EMA, there are probably still buyers there because it's a breakout point and it's a gap. Bulls want to maintain that gap. Bulls also want a double bottom with bar 23 low. So if they're getting that, suddenly we get a big bull bar, we could go upside very quickly. But 3 bear bars, possibly pull back, and we are testing here, testing the trend line. I like to see 1 more and trap and go. But if this is good enough for them, is we could suddenly break out from the upside. It's a bull day. It's a bull trend day. It's buying every pullback. But bears are not happy because they sold underneath. They might be selling above right there, and then hoping for a second leg down. That could still bring market down to the 41.31, 41.28. Bulls see a high 2 is, or high 1, high 2, high 3. So if this bar closes bullish, we could find ourselves right up here. But there's sellers here because it's still a limit order market. and they're not happy that they're stuck here. So they might sell. We'll see a double bottom above the EMA, 23 low and 28 low. So they want to close this bar as bullish as possible and then go. But there are limit order bears up here and they sold already. You can see that it's still trying to come down. That is an outside up bar, 28. So we'll consider that as buy one tick above and go higher and break out from the highs, and they want to get back up to the 4150, 4152 area. But it's still a triangle. We still have not squeezed out of this triangle. Almost there. Can the bears sell this? What if they would actually break out? If they do, there's a gap here. That's because they want to come down and test here. Can we actually test here and then buy underneath the EMA? This is so it's good enough to buy one tick above. Since we didn't get we're not getting any bear bar here, and it's kind of difficult. Like I said, we may not come down to the EMA all the way to the bar 3940. So just be careful if you're selling. I wanted to see market come down here so I could buy that pullback. But if the bulls want to keep that gap open, nothing I could do about it. But I'm doing nothing here. I'm not buying, I'm not selling. It's sideways, it's contracting, so I don't want to. It's gonna squeeze out or break out soon or break down. And if bears show up, can the market come all the way down to 4100? Yeah, they could do that. It's going sideways. We need to trap one side. If bulls want to break out, they have to trap the bears. Bears, I mean, 28 looks like a trap bar, but it really is not. And it's a leg one. They're still looking for a leg two. So I would prefer market to come down to 4131, 4130 area and look for buyers there and then go higher by trapping the bears. That would actually give us up on this down, up, down, maybe, or 1, 2, 3. Third push wedge, then give us a really nice, bigger bull flag setup. So I'm waiting. It would be better if it can actually come down a little bit more. I don't like to buy above bars like 20 if there are consecutive 3 bars before it. I don't like to do that. That could create a double top bear flag. I prefer to buy the trap. It could be anywhere. It could be double top neckline here. Yeah, it could be here. It could be here. Since we did not take out that high, I would assume it's under the EMA, below the 12. That's the last breakout that qualifies as high or low. If they're smart. It's been going sideways for some time, and we have some big bear bars. Okay, so it's just making it difficult for bulls. They try to break out, failed, and now you have 3 bear bars. You need a second leg down. So we need to trap the bears before bulls show up. That's why it's a good bar, outside up, but even the outside up bars, their legs basically in a tight trading range. There could be sellers waiting there, and this leg needs a second leg. So I didn't buy. I want to see a little bit more to the downside. See if we can find buyers around, starting with 31.50 to around maybe 29.50. Is anybody sold here? That's their second sell now. So it should get us here. Okay, so that's good. It's exactly what I thought would happen. Exactly what I thought would happen. So I want to see 22 tested at the minimum, and a further more down in this area is a good buy zone. Market wants to test 41.75. I'm sorry, 31.75. If it breaks it, it could quickly come down to 41.30. If you sold underneath is, with a second leg, you should have sold with a limit order, not with a stop order. If you sold with a stop order, market gave you 125. Okay, it's a solid 1 point, but no more. That's because ATR is 325. Half 3 is 1.5. Add another quarter, just about, right? So 120, 175, 150, 175 right there. So that was the scalp target, the best market is giving you. Now they're trying to trap. See, that could be that trap if this bar now closes bullish, but it still didn't test my support. So I don't know how this bar is going to close. Anybody who's up here bought one tick above against these 3 bear bars, they're buying down here because they know there's a scalp 1 point. They're buying underneath to break even, right? So if you bought above it, you buy again here, you're at the break even. So this bar still could close bearish once those bulls exit out, but it is also the second leg down. If it closes bullish, then the bulls are going to trap the bears. Then I have to wait for the close. I still don't know. The last second this could close bearish, come in here, or if it closes bullish, we go up. Okay, it becomes a trap. That's the trap I was talking about, and we're finally testing the EMA, and that is the first test. Probably buyers were there, I said. So we tested, so limit order buyers entered there. They fixed their break problem. They want to go back to where they got trapped, which is above 28. But this bar hasn't closed yet, so I still don't know if this is going to break out to the upside. But it looks like, okay, so it closed bullish, still sideways. So anybody stuck here, they might be selling that, hoping that it would come to the 50%. Oh, it's a mess. But I think this is, bulls got this because they kind of trapped here, the bears. Bulls need a bull bar here. They need to close a bull bar, but it's still a limit order, except it's just trapped the bears, so the bulls want a breakout. We have 2 is even the third touch. We have 2 up here, so we might test and break out. That would be nice. It is already noon, so Brad Wolf is scheduled to take over. Don't sign off. He will be coming in right after me. I'm going to sign off here and have Brad take over. So can we actually come down and test underneath the EMA? I mean, this is the first touch, and they're buying. I don't know if we would come back down again. I like to see this highs tested, okay, and market to continue to go higher. I still have this area as my target. Okay, so I'm going to let Brad take over. You guys have a great weekend, and I will see you guys next week.
By the way, the mouse is green, and yeah, there should be for those of you in the Discord, if you can actually comment and help others find out where the question box is, that'd be really appreciated. I've got the mouse as green from because people were saying it was hard to see it. So if you like that feature, let me know if it's hard to see. I don't mind it. So if it's helpful, I'm happy to keep it green. So let's see here. Give me just 2 seconds. So we know that obviously the bulls want trend resumption, but what about the bears? And Rose is making some good points in the Discord. She's worried. She's worried about the bears showing up and maybe getting a downside breakout. And there's truth to that. You know, the one issue we have right now is we gapped up and we're at the middle. And I mentioned in the pre-market, there were bears that sold above the April 18th high right here. Bulls bought below the April 26th low here, and we're right back to the middle. And you have to wonder, this is about the midpoint of the rally from here to here, so we could easily sell off. Probably going to be a trading range day. I don't think we're going to get to the open, but I would not be surprised about anything. So what did the bulls? Let me just do one thing really quick here. So let's see here. Let me just make one adjustment here. And we should be good. There we go. So for the bulls, the reality is whenever you get a rally like we have up to 16, and the bears need to do more than what they're doing right now. And that's why traders are buying. They're buying because they know the odds are a trading range. Let's show it on a 15-minute chart. So we can see we have a tight bull channel and a pullback. The odds are it's got to form a trading range before the market reverses. So bulls buy up here, they buy more lower, they get out, break even. Now, what about buying the close of 35? It's probably okay, but you're buying a fairly tight channel, and tight bear channel, I suspect there's probably traders disappointed up here. And because of that, they may use this rally to take partial profits. Okay, great. So people like the green color. I'll answer questions here in just a second. Let me get a few things drawn. Open of the week, but good luck getting there today. Anything's possible, but I do not think we're going to get there. So 34.25 is the midpoint of this week's high. Whenever I'm using TradeStation and I'm drawing lines and I really don't want them to move, what I will do is I will lock it. And what that does is it prevents one from accidentally moving it. So this blue line is the midpoint of the week. And you can see how we're having trouble getting far away from it. Let me just turn on the bar counter. So good bar for the bulls on 35, but look at the context. Tight bear channel, any one of these highs could be a lower high. So you know what the bears are going to do. You will have bears selling the close of this bar. 35 is a big enough bar. It's probably going to have at least a small second leg down or second leg up. So it's enough of a surprise that the bears that sold the 34 high here and scaled in higher here are probably using any pullback to get out break even. But look at the timer down here. You are 2 minutes into the bar and we haven't gone anywhere. And that's a warning that something is wrong with the bull case. If the bulls were so eager to buy, look right here. Bears are making money. They sell, they scale in. This is not what a strong bull trend should do. So whenever you see a big bar, especially when, let me just make this green. It's really the open of the day, not the open of the week. There we go. So whenever you see a big bar and you have consecutive buy climaxes, 4, 8, and 15, and you get a big bar after an extended channel, you always have to wonder, is it a double top? And is it going to lead to a measured move? So, yes, the bulls are doing good, but bad buy signal bars, tight channel down, this is what the bears want. Bears want a downside breakout. And remember what I said. You have to ask yourself, why are we spending so much time at the midpoint of the week? That is a warning that something is not right here. So the bears, they were able to sell the close of this bar and clearly make money. If the bears are lucky, they'll get a double top with 29, double top with 35, break below 34, and go down for a measured move. Would I be shocked if we get to the open of the day? No. So possible here to here, if we break below this channel and get a measured move down, that would take us back to the one high. I don't think we're going to get to the open of the day. I suspect that we're going to really be sideways for a number of bars. On the bar 8 close. So what was the probability on the bar 8 close? Okay, let me read the question. Was the probability of bar 8 a 60% chance it was going higher? Well, there's a few things. So bar 8, when you look at the bar, it's a second leg up from bars 1, 2, and 3. The first 3 bars were, it was a leg 1, it was a breakout. And even though 3 is a little bit climactic, it's probably going to get a second leg. So traders buy the close, they buy lower, they buy below 4, they buy the 5 close, betting on a second leg up. We also had the midpoint of the week just above. 8 is it's a big bar. It's kind of like 3. It's a second leg up. And if you look at 4 and 5, it completely overlapped the close of 3. So you know it's reasonable to expect that 9, 10, or 11 will overlap a lot of bar 8. However, it's still a credible buy the close bar. 4 consecutive bull bars, probably buy the close, scaling lower, and at least a second leg. A lot of traders, when they get buy the close rallies and then they get overlap 4, 5, and 6, they shift. Instead of buying bull closes, they start to buy more pullbacks. So they see 8, they might buy a small position, but they'll start buying lower. Okay, what do you do here? A few things. One, the reality is there's probably buyers below, but 40% chance in general you could get a break to the downside. We probably will not. And this is one of those situations where bulls buy the close, deep pullback, they scale in lower. They'll probably get out break even, others hold to here. So more disappointment, traders buying below bars, scaling in lower. But as far as here, yes, you can see traders bought the close, they scaled in. And look right here. You buy the close of this bar, your risk was here. Market went more than 1 times your risk. What about buying the bar 24 close? Was that 60%? No, I think it's a little bit different there. So here, if you're buying the 24 close, there's a few challenges with it. One is, where do you put your stop? Below 22? If you put your stop below the 22 close, what do you do if the market falls below 22? Well, the reality is you probably buy more above at the 22 low. And that was really similar to yesterday. So let me go to that yesterday. I want to point this out. Well, actually, better yet, let's just go to the daily chart. So you have a strong rally. Let me redraw some of this. That's good enough. And we have an expanding triangle. Draw that too. There's that. There's that. Okay. So if you're a bull and you buy, let's say the close of, you buy May 1st or pull back below May 1st, and you put your stop below April 26th. It's okay to do that, but it's really the skunk stop, because if the market falls below April the 26th, what do you think is going to happen? Well, the reality is, you know what's going to happen. You know there's going to be buyers probably below. So bulls buy, they scale in, and the market allows them out. Bears sell all the way down here, a poor place. They sell more at the high, they still make money. Classic trading range price action. And give me just 1 second. All right. So anyways, going back to the point. If you are, the problem with trading ranges is that it causes traders to end up doing a few things. One, they use skunk stops. They buy 24. There's nothing wrong. I say that. It's not a great area to buy, but the management is more important. And I want everyone to think about one thing that Al says all the time. If you've listened to Al, at any point you've heard him say, 90% of the time you can make money buying or selling depending on how you manage it. Depending on how you manage it is really key for saying 90% of the time you can make money buying or selling using a wide stop and scaling in. That's the trick with management. Bar 24, it's a good bar, but do you really want to put a stop below 22? Of course not. You want to buy more below 22. You buy here, you buy more here, and look, it goes below here, and then races up. So a lot of traders, some buy 24 and they say, yeah, you know, that was kind of a dumb buy. I'm going to buy more below. Look how many chances they've had to get out break even on the entire trade. Let's go to yesterday. Yesterday had a lot of classic trading range price action. And you have to remember the market cycle. You have bears who sell the close, they scale in higher. And by the way, right now on the current time frame of, you know, the current price action, it's going sideways, better just to wait. You have a bear breakout, bars 2 and 3, and you know there's going to be a second leg down. So sellers above, sellers above. 6 is a bear bar, but you know there's going to be a second leg down after 2 and 3. So what do traders do? They start selling. They're selling below 6, they're selling above 6, they're selling the 8 close, they're selling the 9 close. And then you get 10. Well, 10, what if somebody sold the low of 10? We know that because price went down there. If you sold the 10 low and now you're at and the market rallied up to 11, think about the logic. You sold down here, now it's up here. You're disappointed. If you're disappointed, you're going to buy back shorts. So when the market goes back down, what do traders do? They start buying. Bulls, they start buying. Let's look at an easier example. Here, at the end of the day, we had a great example. Traders buy all the way up here. They buy 67, they buy 68, and then they get trapped on 69 and 70. Price went a few ticks below and immediately reversed up. It reversed up quickly, but the bulls that bought, scaled in, made money. Let's go to crude oil for a second, because that is a great example. So let me go to loading right now. Here is crude oil, and we can see, let's go to a daily chart. Look what happened. We had a strong rally up to the highs of April, and then we melted away. Strong bear breakout, testing the lows of March, and then immediately reversed up. Classic trading range price action. So if you're a bull, the worst thing you could do is buy up here and get stopped out down here. So right now, look where we're at. Bulls buy up here, they buy more lower, they get out break even. Bears sold on the way down, they scale in, they get out break even. This is, look who's winning. The traders that are winning are fading every move. They sell above the bear bar, they sell the close of the bull bar. Al would always call it opposite day. Big bull bar, you sell it. Big bear bar, you buy it. Bull bar, sell it. Bear bar, buy it. Big bear bar, you buy it, scale in, scalp out. Big bull bar, closing up here, you sell it. Bulls, they buy 14, disappointed on 15. What did they do on 16 and 17? 17, they got out break even. A sell-off, a pullback, second leg down, falling below bull bars, traders are buying. So the reality is we are probably going sideways to up. But look at this. If the bulls were really in control, this would not be the price action we have. The other thing to remember is whenever you get a strong rally on the open, it's really common for the market to go sideways for a lot of bars. Right now, this was bar 14, this is bar 38, let's just say. That is 24 bars of sideways trading. That is enough to make the market really close to 50-50. So don't trick yourself into thinking that we have to break out to the upside. We most certainly do not have to break out to the upside. And I think we will, but we're starting to get a lot of bars at the moving average. And it's kind of like the euro. I've been talking about for some time. We started to form a channel on the euro. This is the daily chart right here, which is March the 24th. And we've been rallying ever since. And I've been saying that the bears really need to get closes below the moving average. And until they can get closes below the moving average, traders are going to buy. But once they start to get a few closes below the moving average, we could test any one of these higher lows. So for right now, here, we're starting to get closes below the moving average. So it would not take much to get a bear bar and then another bear bar, and then we could just collapse to the open of the day or near it. Bears got trapped selling bars 1 through 3 anywhere in here. And they want it, and that will be a magnet. So maybe the 6 low, or the 5 low, the 5 close, the 4 low, anywhere in there could be a magnet. So for me, the risk is increasing of a downside breakout. You know, on the daily chart, we had a strong sell-off from May the 1st to May the 4th, and we're rallying to where bulls got trapped. If you're a bull, you know, if I was a bull and I bought up here and I bought more on April 26th, that is not what I wanted. And because of that, I'm going to be disappointed. And if I'm disappointed, I probably want out of the trade. Good bar for the bull, good bar for the bears, 38. It's a bear bar below the moving average. But the bulls have kept the market above the moving average for most bars. we've really only got 2 or 3 bars below the moving average. So the reality is there's probably buyers below. But if the bears start to get 2 or 3 bear bars, we could collapse really quickly. But once again, bear bar 39, bulls buying. Okay, question, do you give much attention to the cash index, or do you give priority to the futures only? I see a gap in a measured move. Well, let's first answer the first question. My priority is the chart in front of me. So if I'm trading a monthly chart, my priority is the monthly chart. If I'm trading a 5-minute chart, my priority is the 5-minute chart. It's fun to notice that the midpoint of the week is right here, but the reality is we don't need that. You'll see my charts a lot of times have hardly any lines, and in part because you really just don't need them. You can look at the price action. Yes, there are things not on my chart that we could discuss. I'm sure if Tim was in the room, he would probably start talking about some sort of measured move or trace, measured moves up, even right here. Measured move of this trading range takes you basically to the midpoint of the week. There's all sorts of different things we could look at. But the point is, price action will give you all that you need. For me, on this chart, I see a parabolic wedge, 4, 10, and 15, and I see an endless pullback, and now I see a bear breakout. And what did I say a few minutes ago? We could fall very quickly down here. If everyone agrees this whole thing's a trading range, we don't know where the bottom is, and the bottom could be down here. So for me, the bulls are getting trapped here, and they need to be very careful because this could break out really, really fast to the downside. And to me, this is already becoming always in short. It's a strong enough breakout that we're probably going lower. So when you look at this and you think, how could that be? This is happening after a lot of bars. Well, look what happened. A lot of bars up, yes, but we went sideways for a lot of bars, making the market neutral. And on top of that, we had closes below the moving average, and the bulls are just not doing enough. So the other thing, we have targets below. Strong enough breakout, probably going to get a small second leg, but the bigger the tail, the more disappointed traders will be. So some traders sell on the way down, and they sell back up here. Why would they sell up there? A few reasons. If you're a bear and you sell the 38 close, 39 close, or excuse me, if you're a bull and let's say you bought the 34 low, and you're looking at this and you're thinking, I'm going to get rid of these lines, it's a little distracting. But you're looking at this and you see 34, you buy the 34 low, you scale in. Are you happy that the market went this far down, or are you thinking, I don't know, that's disappointing, and maybe I should buy and scale in and try and sell out of longs around as close to the 34 low as possible. So that means there's probably traders selling here and scaling in. 40 is a little bit disappointing, and it will increase the chances of traders selling a pullback. But if I had to guess, there's probably sellers around the 34 low. Disappointed bulls who bought the 34 low and scaled in. But 40 is a disappointment bar. And that will increase the probability that bears will scalp out. So, do you buy above 41 if it's a bull bar? For the bulls, they can argue it's a wedge. 3 pushes down. 21, 34, and 40. So that is good for the bulls. But we may go more sideways here. It's about a 50% pullback. pretty much 50% pullback. So if this bar closes on its high, I suspect a lot of bears will be disappointed enough that they will look to exit any shorts. But the reality is there might be more sellers above 40 than buyers, so we could get a deep pullback to the middle of this bar. But so far, pretty good buying pressure. This is certainly trapping bears into a bad short. So the bulls, they want a bull bar closing on its high. They want a wedge bottom, 22, 34, and 40. And they want to rally back to the highs. Good bar for the bulls, probably going higher, but tight channel down to 40, trapped bears on the 40 close. We could get a fairly deep pullback on this current bar. And we could easily get back down to near the 40 close. You'll have bulls buying a 50% pullback from the 40 low to the 41 high. So the question here is, how desperate are the bears to get out? We know bears are disappointed who sold the 40 close. They probably scaled in higher above 40, and they're trapped. So I suspect a lot of them are interested in exiting. First target for the bulls is the 35 high. They see a wedge, 3 pushes down, 22, 34, and 40, and therefore they want the market to get up to the 35 high. It's really a problem when you get breakout attempts on the third leg and they reverse. There's a higher tendency for it to reverse and rally pretty sharp. So this is certainly a problem for the bears, and it makes me think that the market is probably going to go higher. So far, looking good for the bulls. You can see, look at this bar. Is this bears selling aggressively as the bar's going up, or is this bears taking profits? Or not taking profits? Is this bears exiting above 41? So if you're a bear and you sold the 40 close, and then you see bar 41, and you're disappointed, how are you feeling about this current bar? Are you saying, gee, this is exactly what I want to see as a bear who's looking to sell higher? Of course not. And because of that, you know traders are exiting. So we could easily test up to the high of the day. We're testing the 35 high, first target for the bears, first target for the bulls. Let's see if we get a strong bull close. One way to look at this is take a look at lower time frames, and you can see right here, bull bar, follow through, another big bull bar, another bar, another bar. Very strong rally on the 1 minute chart. And what that tells you is this rally from 40 to 41 was very strong. There was not that much of a pullback, so it trapped a lot of traders. So to me, this has the potential to get up to the 15 high. What about sellers of 36? There might be, but I suspect with the rally from 41 and 42, assuming this bar closes on its high, which is only a few seconds left, I suspect we're probably going to get closer up here. So instead of selling 36, I'd rather look to sell at the high of the day. Bull bar, follow through, probably going a little bit higher. For the bears, for the bulls, they want leg 1, leg 2. Rally up to from bar 1 to here. They want to pull back and a rally way up here, but probably won't get it. But at the moment, we're clearly always in long and probably going higher. Still always in long, probably going to try and test the 15 high. 3 consecutive bull bars, but 43 is smaller, so we might pull back first. We have a wedge, 22, 34, and 40. So I suspect we'll probably get at least a second leg down. Probably going to try and test the 14 high. We have not gotten above the 18 bar range. So I suspect we will probably, at a minimum, break above the 15 high, which is 15 high, which is the high of the 18 bar range. So 90% chance in general we're going above this blue line. Doji bar, so a warning that the market may start to go sideways fairly soon. But because we have not gone above the 18 bar range, I believe we probably will try and get above it. But 44 is a warning. Now there will be bulls disappointed that bought around 14. And you know some of them are going to use this rally to take profits. So if we start to go sideways, more and more traders will be fairly quick to exit. We may have to have a pullback first before we get the second leg up. But again, we have yet to go above the 18 bar range, and we're a lot closer to the high of the day than the low of the day, which makes me think if we're going above one of them, which we probably are, we're probably going to go above the 15 high before we go below the one low today. But remember, try and ask your questions in the webinar question box, because it's easier to keep them all in one place. You can see more disappointment after 44. 44 is a hesitation bar after a 3-bar breakout, 41 to 43. And so it's a warning that the market may start to go sideways. Because of the strength of 44, 41, 42, and 43, I suspect there's probably buyers not far below. It's important to realize we're trending every bar ever since 41 has gone above the high of the prior bar. And that is a sign of strength by the bulls. So still probably going a little bit higher. Another doji bar, a sign of more trading range trading. It's okay to scalp out here. You have to be, the odds are we're going to get above 18, but you're at the top of a trading range, and one needs to be mindful of what are they willing to risk betting that we'll get to 18. So in other words, if you're buying here, where's your stop? It doesn't matter if you bought the 40 closed, if you bought above 41, if you bought the 42 closed. What matters at this second is the current price. So right now, your risk is from the current market price to your stop. It doesn't matter where you got in. And because of that, you have to ask yourself, what are you willing to risk? You can see the momentum is drying up. The bears are not making money below bars yet, but it would not take that much. The reality is, because of the strength of this move, there's probably buyers at the 41 high, the midpoint of 42, and we'll probably get a second leg up. But for the bears, they want a double top here. Maybe this high, maybe the 25 high, one of these highs. I would be more, I do think we will try and get above the bar 18 high. What I don't know is, do we pull back first? So here's the middle of, we're in a trading range here, past couple bars. Here's the 18 bar high, here's the middle, and the measure move down is the midpoint of the week, but probably going a little bit higher. But I think it's certainly okay to take profits before we get there. We have another high one by 46, but bad signal bar. And whenever you're buying high in a trading range, you need to be really, really quick to assess the momentum, because when the momentum dries up, it can easily reverse. Okay, so we broke above the 18 bar range as expected. So still always in long, trying to get a second leg up. And again, whenever you have 3 pushes down and we have 2 legs up, there's a lot of comments asking why the 18 bar range. And Al talks a lot about that. The reason for the 18 bar range is typically the high or the low of the day is not set within the first 2 hours. In other words, by either around bar 18, usually you break above the high or the low of the day, and there's a 90% chance when you break above the 18 bar range, you've seen the low of the day. When you break below the bar 18 range, there's a 90% chance you've seen the high of the day. So let me do this. What I do, whenever I'm trying to find the 18 bar range, you can see I'm on the encyclopedia of chart patterns. What I do is I'm always forgetful of where everything is, but I know at least how to navigate the spreadsheet. So I'm going to search for something that's common, like the 18. Here's a bear breakout below bar 18. I know that is part 1. So next, I go to part 1. I'm going to look up. I know there's 18 bar ranges in here. Haven't noticed that slide before. I just wanted to click on it. Here's the bull breakout of the 18 bar range. And you can see right here. And we're always in long. It's okay to be long, but you're buying high in an area where bulls got trapped earlier. So to me, I think it's more of a profit-taking area. But anyways, let's take a look at this slide. First bar of the day, only 20. And these are generalities, but if you've listened now or you've been in the video course long enough, you've heard him say this numerous times. First bar of the day is about a 20% chance of being the high or the low of the day. That is a very important rule. And then by the close of 7, there's a 50% chance the day is formed the high or low of the day. That's why in the blogs, you'll often hear me say, wait for 6 to 12 bars, because just by waiting 6 bars, you greatly increase the chances of catching the high or the low of the day, and you avoid all of this. Bar 18, 80 to 90% chance the day is already formed either the high or low of the day, but not formed both. Bar 80, there's a 99.99% chance the day has already formed the high or the low of the day. Now, one thing about probabilities with Al is he is pretty close to probabilities as far as accuracy. He is not trying to be literal. Bar 80 probably is not 99.99% chance it's the high or low of the day. But the point he's trying to make is think logically. When's the last time you've seen bar 80 go above or below the form a new high or low of the day? In other words, break below both of them. Probably not, because that would mean the market would have to be up here and have to go all the way down there. So the point is, when you're looking at probabilities, it's close is close enough. So let's find an example of today. Here is, and this is pretty good. This is pretty common. You rally, there's bar 18. You get really close to it, and you start to creep sideways. So for me, I'm always trying to pay attention to the 18 bar range. Because when you go above it and you start to sell off, you always have to wonder, you look back and you say, wait a minute, and that's why 18 is blue on this chart. It's a reminder that it's an important number. You say, wait a minute, we're starting to rally on 41 and 42, and we didn't get above the 18 bar range. We're probably not going below bar 1. That means if I'm buying above 41 or 42, probably should go above here. So that is the logic behind the 18 bar range. And you can find it in, let's give everybody that's asking questions about the 18 bar range, I want to give a little bit of maybe homework to study regarding the 18 bar range. Let's give everybody that's asking questions about the 18 bar range, I want to give a little bit of maybe homework to study regarding the 18 bar range. It's trading the open, obviously, but I'm looking to see which video. It's one of the trading the open videos. I'm forgetful which one. But anyways, it's one of them. So 50, we have a doji. Is it by the close? It's still technically by the close, but for me, the bulls are trying to get a measured move of this. And to me, we're probably going to go more sideways. Therefore, kind of like you see 50's a doji, we may start going sideways fairly soon. So to me, we might be forming the early stage of a trading range right here. What about selling? The reality is bears selling here and scaling in are probably going to make money. In other words, we're probably going to fall below the bar 15 high. My only problem with selling is you're selling a fairly strong rally, but it's a little bit parabolic, and we're stalling at an obvious resistance level after breaking above 15. We can certainly go a lot higher. I don't think we will. This is a good bit of damage done by the bull, but done by the bears. Let me look, there's some more questions. So that is the logic behind bar 18. Do I give much attention to the cash? Oh yeah, I didn't answer this question. Do I give much attention to the cash index, or do I give priority to futures? I give priority to what I'm looking at. So 5-minute chart, this is the most important chart on this screen because this is what we're talking about. Everything else is secondary. You'll go crazy if you're looking at the 60-minute chart trying to make a decision, then the 15-minute chart. And then what about the 30-minute chart or the 40-minute chart or the daily chart? I pick a few things. You know, on the daily chart, I'm drawing a few things, but for me, if I can't look at the daily chart and just see something that is just simple and obvious, and then I'm going to ignore it. So for me, if I look at today and I say, yeah, it's kind of the midpoint of this sell-off, maybe that's important. We broke below. I know that bulls bought. They bought more here. They might get out break even, but I don't need to know that. This is most important. So for me, the cash index I generally will use for the weekly or monthly charts. You can look at the E-mini on the monthly chart. It's going to be close enough. I mean, it's just cash index. You know, it's basically the S&P, so why not look at it? You can look at the Dow Jones. We could say the same thing for the Dow. It'll obviously look slightly different, but it looks pretty much the same. E-mini, we can look at the E-mini. It's going to look the same. Or we could look at the Globex. It's going to look the same. Let me follow up with that question. But 50 is a warning that the bulls might start taking profits soon. You're getting open gaps, though, so we could go a lot higher. We could break out strongly to the upside. We could get a measured move from 40 to bar 15 high. All sorts of things we could do. It's Friday, late in the day, or not late in the day, it's Friday, basically the afternoon session. So the weekly chart's important. We're already above the midpoint. What about getting to the open of the week? Well, that's about another 40 points. That's another 40 points higher. And to me, that is just too far. That's all the way up here. So I don't think we will, but anything's possible. So follow up to this person's question, they see a gap and measure move up with March 22nd, but the gap is closed on the futures chart. So yeah, this person, what they're saying is on the daily chart, they see a gap and measure move, March 13th low, March 22nd high, takes you up to here, but they're saying it closed here and here. It did, but this gap could be this high, it could be any, what we don't know is if the gap is from here, this close, the March 13th low to the March 21st close. We don't know if it's here. It could be anywhere in this area. The market closed below the high of this gap, but that doesn't mean it's still not valid. So in other words, this could just be a negative gap. And again, I mentioned on the blog, this could be a double bottom, April 26th, April 4th, and take you up to here. Possible exhaustion bar on bar 51, but who's going to sell it? Some traders will sell it, and some bulls will sell to take partial profits. But to me, that's a pretty dangerous sell because you're in essence selling in a very tight channel, and the reality is there's probably buyers below scaling in lower. 6-bar micro channel, small micro gaps closing, probably going to pull back soon, but there's just no way I'm selling right now. If anything, you're buying and buying pullbacks. It's okay to take partial profits. Maybe a measure to this close, maybe the low of this bar to the close of 42. But, so clearly always in long. Can you explain more about the importance of the midpoint of the week? Yeah, the midpoint is a magnet for a lot of price action. I think Al said it yesterday, price action likes the midpoint. Price action likes 50% retracements is a better way to put it. Almost 50% pullback. Now, why did we stop at 40? Well, look at bar 6 high. The high of bar 6 is 27 even. So if you bought above bar 6, what was your entry price? It was 27.25. Look at the low of this bar. It's 27.25. So it touched the high of bar 6. Basically, if you're a bull and you bought one tick above this bar and move your stop to break even, you got stopped out to the tick on 40 only to watch it reverse up. But midpoint of the week is basically 50% pullbacks. You can buy up here, and especially if you can scale in. I mean, this is a problem for the bears that started selling and scaling in. So for me, if I sold a breakout on 40 and I see 41, I should get out. If I see 42 going up, I have to get out because there's too much risk of this happening. Thank you. So Lyndon says video 45 is about the 18-bar range, so go there. Okay, scrolling through some more questions now. But you can see how 52 is another doji. So we get a doji on 50, bull bar 51, closed on its high, and then a doji 52. So it's going higher, but it's getting parabolic and it's starting to hesitate. That increases the risk of a pullback. Okay, back to questions. Someone asked, stop below 12 low. I'm not sure what you mean there. Here, though, it's always in long. You can put a stop below 46. The reality is there's two ways to really think about this. One is your premise. So for me, if I'm long, I'm not right now. I wasn't long. I bought on the way up and I got out a couple ticks under the 18 bar high range. And I thought about getting out in here, but I thought the odds were we would get to 18. Here, if I'm long, I'm always thinking about tighter stops. Small pullback trends. If this is going to be a small pullback trend, I don't think it will. That's why I'd rather buy lower. I don't want to stop all the way down here because why would I not want to stop below 40? The reason is I know that putting a stop below 40 in a situation like this, I'm basically exiting in the middle of a tight trading range. I don't want to do that. I want to sell high in a trading range. I don't want to sell in the middle or low in a trading range. Therefore, for me, I think about it from the perspective of if this is going to be a bull trend, which if I'm buying high, I'm hoping it's a bull trend. So if this is going to be a bull trend, then what would happen? What would need to happen for me to think it's a trading range? Well, one idea is, let's go back to Al's video course and everything he talks about in his books, are stop entry bears making money. So when I look at this and I say no, stop entry bears haven't made money since over here. Okay. So check mark for the bulls. That's good. What about sellers making money above bars? Can bears sell above bars and make money? Not really. Okay. So maybe one premise is as long as the bears are not making money below bars, I will stay long. So then maybe I say, okay, I'll put a stop arbitrarily here. Or maybe I'll put it, if the range of this bar is a point, it's a pretty small bar, maybe I'll put it 2 times down, so here and here, and I'll say, okay, we shouldn't go all the way down here. Reality is we probably shouldn't go even to here, but that is what traders are doing. So a lot of traders use tight stops, betting that we should go sideways. It's like 35. Traders made money buying it. Let's see if they made money. 35, 34 even. They made 2 points if they bought above 34. A bad looking bear bar. So with all this buying pressure here and here, increased the chances of this breakout failing. So look right here. If this is going to be a strong bull trend, the bears should not make money selling below bars. So right now, bulls are trying to prevent the bears from getting to the high of this blue line, the high of the day. I'm going to delete this now just because we've gone above the 18 bar range. All right, I'm going to go back to questions. Question, if bar 37 triggered, is it a reasonable buy looking for a new high? Well, 37 is not really ideal. And here's my problem with 37. You heard me mention it here. I said, is 35 a good buy? And I said, not really, because it's a big bar forcing you to buy in the middle of this mess. And there's probably buyers somewhere below. So if I'm buying the 35 close, I'm buying more below 35 or 34. Then we get a bear bar, then we trigger below. But if I bought here and I'm disappointed on 36 and I bought more below 36, what am I doing? I'm probably going to get out break even. Break even traders typically always get out first. So bulls buy more here, get out break even. And you can see it led to a second leg down. So I think this was more so due to traders selling. Bulls disappointed that bought the 35 close, exiting as 36 is going down. Some of those traders bought more below 36, getting out break even. Question at 11:58, which was here, somewhere in this area. Would you still wait until close to buy above 41? I thought it was okay. Buying above 41 is probably okay because you know bears that sold on the way down are trapped on 41, and if the market doesn't race down quickly, they're going to start to bail out. And you can see a lot of traders, it could not even fall to 50%. So traders were buying above 50%, which is a sign of strong buying. So look at this. Bulls buy the 51 close, disappointed 52, 53, and we're getting a pullback. So what about buying at the market below 53? It's probably okay, but small consecutive buy climaxes going down a little strong, probably going to go and get at least a second leg up. But trading range day, we have a lot of selling pressure in here. The pullback could be deeper than what traders want, but the reality is traders are buying. We have a trading range bar on 50. Trading range bars often are the start of channels. We have a breakout. This is kind of, I don't want to be confusing, but markets are fractal, and what that means is you have patterns made up of smaller patterns of the same. I believe a snowflake is fractal, and the reason is because they say if you look at a snowflake, it's made up of the same patterns of smaller patterns make up a large snowflake. Same thing with trading. We have a breakout on 51 or a breakout on 47, 48, and 49. 3-bar breakout. We have a pullback in the start of the channel on 50. We rallied. We're testing the bottom of the channel at the 51 low. So it's trading range bar. It's not area of neutrality. When you have a tight rally and you start to get sideways doji bars, the market will often test the midpoint of those trading range bars. Someone asked in the Discord, do we want bulls to be trapped when we short like now? This was at 950. So at bar 16, do we want bulls to be trapped when we short like now, or chances are better for bears? I'll think about that question for a few. It's a little, let me read it silently for a second. Okay, I think what they're saying is, in general, do you want bulls and bears to be trapped? Strong breakouts occur when traders get trapped. Easy example, look at 40. 40's racing down, and it makes you think that we're going to break to the downside. But then in the final seconds, it starts to race up. And I thought there would be sellers around 39, but then looking further, it's a wedge bottom, which lowers the chances of sellers being here and increases the chances of going to the top of the third leg. Wedges, typically, it's very common for wedges to test the top of the third leg, or wedge tops to test the bottom of the third leg. And 40, when the market's going down, you have bulls, a few things. You have bears who sold in here, scaled in, disappointed. You have bears that sold the breakout, trapped as it starts to turn up, and everybody's buying on the way up. That creates a strong breakout. Why are these breakouts not strong? Well, where are traders trapped? Bulls buying 24 it's not a great buy because it's relieving traders that bought in here. Bulls bought 14, disappointed 15 and 16, getting out break even 17. Bulls buying 35, but if you think about it, bar 22 to 24 was a leg up, deep pullback. Arguably the bulls should have gotten a second leg, but those bulls got trapped and we got lower prices. So if you bought anywhere in here, what are you doing on 35? You're exiting break even. So now we have a high one buy on 34, and that increases the risk that there might be more sellers above the high one than buyers. Those sellers are probably selling for a scalp, but it's basically an expanding triangle, tight trading range, so not really all that ideal, but kind of dangerous to sell because the reality is there's probably sellers above, but there's probably buyers somewhere below. Let me look at some more questions. Okay, question, looks like bulls, this is at 11:59, 12 o'clock in this area around bar 40. Looks like bulls kept bar 6, which is here. Looks like bulls kept bar 6, opened by 1 tick on the bar 40 sell-off. That is correct. Bar 40 sold off, but it did not get to the high of this bar, so it's not a strength. What are the chances it closes today? Well, obviously it's low now, but that's obviously an hour after you asked the question. But to me, it was reasonable. It's a decent stop entry buy. We tested the bar 6 high on 40, but when I see 41 and 42, I think the game is over for the bears for the next 10 or so bars. Strong enough breakout 41, 42. I'm thinking about a second leg up. And now when I see this rally, I'm thinking this is pretty strong, and it's probably going to have, ignore that on the Discord, it's probably going to have a strong second leg. So on a higher time frame, I did it again. Now I've said it before, I've got a keyboard connected to 2 different computers. And I just use that just because I don't want 2 or 3, I don't want 2 keyboards on my desk. So it's just Bluetooth. But anyways, tight bull channel and probably buyers below scaling in. By the way, whenever your technology is a great thing, but I've learned this comment from several people, and that is whenever you have a lot of people, including myself, a lot of people, they have laptops and they'll connect it to monitors, close the laptop and connect it to like a wireless keyboard and all that. And that's good. But the one thing I would suggest is whenever technology can fail, your mouse can die, your keyboard can die, and the last thing you want is to be in a trade and to not have any ability to, if you're, for example, I buy at the market and the market starts to sell off, but then all of a sudden my Bluetooth mouse disconnects. If my computer is closed, if it's a laptop, it's closed because it's connected to a monitor and it's under my desk. What do I do when seconds matter? It's probably not going to be an issue, but you want to have a way to manage it. So for me, I keep the trading room computer under my desk, closed, connected to, it's just Bluetooth. But my actual trading computer, it's connected to the same monitor on the other side because it's a wide monitor. I use my trading computer, it's connected to a Bluetooth mouse, but the keyboard to the computer and the trackpad is next to my finger. So if something was to happen, if my keyboard broke or the batteries died, whatever happened, it got disconnected on Bluetooth, I can at least use the laptop keyboard and keys to manage the trade. And that's kind of, I get it, that's kind of overthinking, but I think it's really important to expect technology to fail at some point. So this is what I was worried about with selling above 54. I thought there might be sellers temporarily, but they would ultimately buy and scale in lower. And in this case, bulls that bought made money. So again, a painful reality for the bears that sold down here. Let's think about measured move targets. Midpoint of the week, it got deleted, but it's basically this line. I don't think we're going back down there. Measured move from the lows here to the high here, all the way to 41.55. Probably not going to get there, but with the selling on 52 and 54, makes me think there's probably sellers above. It'll be interesting to see. Can the bears that sold the 54 high scale in and make money? Interesting to see. Can the bears that sold the 54 high scale in and make money? 55, a little bit of a climactic bar, so there might be more profit taking on the close at 55 than sellers. Question, 43 small buy. 43, it's a follow-through bar. It's small. Despite closing above the 35 high over here, let me reread the question. What's the probability of 43 going higher? Is it 55% going up? Well, 43, that's basically the question. 43, it's a follow-through bar after 41, 42. And there's a few things going for it. One, the structure of the day is a trend from the open. It's basically a trend from the open, 3 pushes up, but it's parabolic, yes, but it's tight bull channel. We have a sell-off, good for the bears, but usually you get a rally, which is very tight, deeper pullback than you want, and then a test of the highs. Sounds crazy and scary, but the bull that bought the 15 high put a stop below 1 and scaled in efficiently lower. In other words, they bought, maybe they scaled in. If their stop is 41 to 12, so let's just say it's 30 points, they scale in, so they buy at 41, they buy more at, let's say, 31, they get filled. They were going to buy more at 21 and then buy more next to their stop. They clearly made money. But to me, wedge bottom 22, 34, 40, 3 good bull bars, probably going to test the 18 bar range. So I thought it was very reasonable to buy the close of 43. Now I'm flat. I haven't taken a trade since buying as 42 is going up and getting out here. But I think it's okay to be long. I would rather enter closer to the moving average. Okay, I talked about 90% chance of the 18 bar range. Question, if you sold the 40 close here, is it better to exit, scale in, or try to break even? Yeah, so actually, I sold on the way down, and I misread it as a third leg, and I got out basically the high of the bar. I sold on the way down, sold more at the high of 40, and I was taking a chance I could get out break even. And long story short, when 42 went down and started to go back up, I reversed my position. So on the matrix, at least for TradeStation, I'm sure for most, there is a close the trade button, there's a reverse button. I'd be very careful about just immediately reversing a position, especially after you scaled in, because if you're wrong, you can get just killed twice. So you sell here, you scale in, so you're in a bigger position. And as the market's going up, the worst thing you do, you're already taking a bigger loss than you want. But by reversing to long, I was basically able to, by reversing to long and I got out, I made up more, a good bit more than I lost. But I was a little slower than I wanted to. I should have just gotten out right above the bar, but I got out around the midpoint. For me, typically you want to be careful about trading the third leg of a move. And so really, it was a dumb trade. I should have waited. For one, I should have waited for the bar to close. But two, it was actually a dumb trade because there were trap traders down here. And that was just a careless error on my end. But with 3 pushes down, I'm very careful. I get worried. For me, I wanted the market to go above here and immediately go back down and close with a small tail. But for me, when this bar closed on its high, wedge bottom, I know decently high probability we're going to test up there. So it's kind of a race against the clock. If you scale in, you have to have a way to get out. So for me, I'm okay with maybe holding above 41, although the context is bad, 3 pushes down. When I see 42, 2 consecutive bull bars against me, in a wedge bottom, in a likely trend resumption day, there's no way I can be long there. So if I'm flat, that means there's no way I can be short there. So if I'm flat, it means I have to get long. But back to this person's question. 56, again, look what's happening with 54 high. Bears that sold 54 scaling in, getting out break even, or making money. So tight bull channel, yes. And remember what I said around 51? I said if traders are buying, they're probably using a stop at least a scalp distance below the bar, and they haven't been stopped out yet. So the bears need to make money below a bar to convince traders we're going lower. Okay, so question, this was at 12.19, so basically 12.20, which is bar 46. Do the two bull bars on the 15-minute, one closing on its high, add any value to the potential 5-minute decision to be long? Yeah, what this person's saying is, that is, by the way, bears making money selling above bars. They sold the 54 high at 44.25, did not panic. They sold more higher, and looks like they're going to make money. Yeah, if you're looking at a 15-minute chart and around 12.20, you see consecutive bull bars, you know the tail on this is a rally. Here's a 1-minute chart. And this is 150. Here is 12.20. So from here to here is what we're talking about. And the point with that is, the point behind me making that is you have to understand what this looks like on a 15-minute chart. What does this look like on a 15-minute chart or 30-minute chart? So for me, one way I do that is I practice trying to visualize what do higher time frames look like. What does this time frame look like on a higher time frame or smaller time frame? On a higher time frame, I know it's a rally, pullback, and a second leg. So I know on a 60-minute chart, here's bar 12, it's a bull bar. We rallied for a few bars, deep pullback, so it's a bull bar, and then probably a sideways bar, maybe another sideways bar, and then a rally. So if I go to a 60-minute chart, I don't want to do that because it'll mess up the bar counter. We have a bull bar, sideways bar, bear bar, another bar, and then up. But anyways, yeah, you can look at a 15-minute chart. I mean, that's great. The reality is when you see this from here to here, you got to figure out a way to buy. So for me, the only thing I'd be doing is buying and scaling in. But for me, I want to buy lower. And that goes back to the moving average. The moving average is a great, simple tool that traders have. It is a reflection of the average price. So if we're above the moving average for a lot of bars, the channel's tight. I've talked about that a lot in reference to the euro dollar over the past couple of days or weeks. Euro dollar, the daily chart, we have a breakout above the moving average, and we've been above the moving average. We've had bodies completely above the moving average for a lot of bars, and I just know that that means the channel's tight. So Al will often say, if you look at the pullbacks and they're only lasting 2 or 3 bars, or it's clear that counter trend traders aren't making money on stop entries, the channel's tight. Another way to just see if the channel's tight is just look at a moving average. If most of the bars are below or above the moving average, it's more bullish than bearish. Let's just take this same chart. And the other thing with trading, you have to learn to really just believe that it doesn't matter what time frame you trade. Here's a rally. We went above the moving average, below it, above it, below it, above it for several bars, below it. So you know we're in a trading range. We spend a bar or two above it, we spend a bar or two below it, back and forth, back and forth. Greater chance of an upside or downside breakout. Big bull bar follow through, spinning a lot of bars above the moving average. Therefore, you know the moving average is going to be support. We broke below it, but we've been above it since here. We may go a little bit lower, but probably buyers. And then we found buyers. But this is enough selling to probably make it go sideways. So away from the moving average for a lot of bars, but we've been sideways since bar 51. If you bought the close of 51 and you're still long, you're underwater now. You've been long for about 7, 8 bars. That's disappointing. And disappointment is a reminder you're in a trading range. So for me, when we start to go sideways, traders are willing to buy high, like the 3 close or pullback, when you're far above the moving average and there's strong momentum. Traders are happy to pay more. When you have a lot of overlap, traders don't want to pay more. So you start to get a lot of trading range price action on 16, 17, and 18. Guess what happens? We go sideways until we get closer to the average price. We get a bull bar like 42, 43, strongly going up. Traders are happy to buy above the moving average. But then we start to go sideways, and guess what? No one wants to pay above average. They want to pay below average, which means we're probably going to get closer to the moving average. And again, my other problem here is it's easier to show on maybe like a 30-minute chart. Here's my issue. I'm just trying to play with the time frame to see if I can. Let's just do, what is it, 60-minute chart. We had trading range price action here. So you have to wonder a few things. One, I certainly think it's reasonable we get back to the midpoint of this range, because if you think about it, look to the left. We're in a resistance area, and you can see that on a 5-minute chart. Let's just do that first. See all this trading range price action here? If you're a bull and you bought and scaled in lower, you're disappointed. The bulls failed in this area. We're back to that area. So what do you think is going to happen? Probably going to fail again. You can see that on a 60-minute chart. Bulls bought anywhere in here. They got trapped on this big bear bar, went lower. We're back to this price level. So if you're a bull, maybe you used a stop, measure move from here down to here. You bought on the way down. We're back to it, probably going to go sideways. Another comment about small pullback trends is small pullback trends generally do not have a lot of trading range price action. So let's go to, and again, I'm always forgetful of where everything is. So where is small pullback bull trends? And I just saw it, part 13. So I'm going to go to 13. I'm going to look up small pullback bull trends, and here's what I want to show. Notice how a lot of these we stay above the moving average for most of the day, and that's what we're doing right now. But what you'll notice is the strongest types of trend days, you do not get, you, for one, don't get a lot of bars below the moving average, but two, you do not get 2 or 3 consecutive bars. 2 bars down, 2 more bars, but if you sell below anything, you're not making money. Sell below bars, you lose money. Sell below bars, you lose money. Same thing here, same thing here. Now, why am I showing this chart on a day like today? The reason is we are trying to form a small pullback trend ever since 41 and 42. We have a lot of trading range trading here, and really ever since this area we've been in a small pullback trend. Bears have not made money since 39, and this is 59. So for 20 bars, bears have not made money below bars. And a general rule of thumb for me, if I want to see if bears have made money, I just measure the stop entry. So if you sell below this bar, if it only goes exactly 1 times the range of the bar down, that's not good enough, especially when it's a bad looking bar. So bears are starting to make money selling above bars, but it's still a little problematic. They're selling above bars and making money, but they're not making a lot of money, and bulls are buying pullbacks. So probably going to go sideways more. But if we start to go sideways for long enough, we could break back to the downside and test around the midpoint of the week. I want to see what the midpoint of the week is. It'll be interesting to see if this bar closes on its high, if we get to the February 2nd high. So again, I do think we're going back to the May 1st low. My thought was, would we get a pullback first? So you see a lot of small pullback. By the way, whenever you're in a trading range, you'll see more small pullback or trending days, because the market will sell off and abruptly reverse. It'll sell off on 26 and abruptly reverse. It'll sell off on May the 4th and abruptly reverse on the next bar. First, okay, 425. So I wanted to get the right price level. I knew it was 34 something, but it was 34.25. Oh, what weird. That was gone a minute ago. Anyways, let me grab one sip of water, and then I'm going to talk about we're going sideways. It's a limit order market, but I want to buy at the moving average. Number two, I want to talk about the dollar-yen on a daily chart, because that is a fun example of a few things. Just 1 second though. For those in the Discord, help me out really quick. I cannot tell if my screen is paused or not. Can you see price moving? I hit the pause button. I can't tell if it's unpaused. Okay, great. It's moving, so it's not paused. Okay, thank you all for that, and I will be right back to talk about the dollar-yen. I turn my screen off because I want to. It's really dumb whenever you have. One thing that annoys me with TradeStation is you want to make a black and white chart, but if you just set the bars to black and white, the data window, you can't read it. So if you can read this data window, it's kind of grayish. And the reason for that is it's not completely black. It's like it's a lighter version of black. And this screen, I wanted to paste over a new chart just so it looks a little bit easier to read. Okay, give me just 2 seconds. By the way, when you see this, you can't be in denial. I wanted to sell up here because we're at the top of the trading range, but when I see this, it's either buy below bars, buy lower, but do not sell. Good bar for the bulls, but we're 2 minutes into a bar, and for me, this might be more of a profit-taking bar. So let me go back. We have this measured move target up here. We have a leg 1, leg 2 that we know we can draw. Go back. We have this measured move target up here. We have a leg 1, leg 2 that we know we can draw. Leg 1, pull back, leg 2. And you can see they correspond pretty close with each other. Now, it's possible to make things confusing for everybody. Sometimes rallies, you can get notice right here, we have a rally up to the 11 high and a pullback. But sometimes you can get a rally, and even though you go above the rally, like for example, if I take the leg 1 traditionally from the 1 low to 15 all the way down to 40, it takes you up to here. Some traders will say, yeah, I don't know. I think the rally or the first leg ended on bar 11 because 11 had a deeper pullback. And that means that I think that the rally to 15 was part of the pullback. So we sold off, and it was a pullback from the sell-off, and then we got a second leg down. In other words, leg 1 to 12, pullback to 15, leg 2. And notice how a leg 1, leg 2 of that takes you to the tick, 52.50. The high of this bar is 52.50. probably going to go higher. For me, it's enough of a surprise, probably going to get a second leg. But you always kind of have to wonder if 14 or 15 is an outlier. But to me, we have obvious targets above, and there's not much to the left. So for me, I think it's a reasonable profit-taking bar, but I'm just really resistant to wanting to sell this tight of a rally. This is pretty impressive for the bulls, but it's a strong enough bar. It's climactic, and traders will look to take profits on the bar. In general, when you get a bar like 60, it's also the close of the 60-minute chart, so let's look at that really quick. Corresponds, so you can see we rallied pretty strong in the final 5 minutes of the bar. Whenever you get a bar like 60, we know it's climactic, increases the chances of profit taking, but in general, 60% chance you can get profit taking, or you can get a second leg before you get a pullback. So for me, it'll be interesting to see. Can the bears sell the high of 60 and exit around the midpoint? So if this is a sign, is this going to be a measuring gap, or is this going to lead to exhaustion? So some bears will sell the high of 60 and they'll look to get out around the midpoint here. Other traders sell, and they do it like maybe they do this. They sell the high of 60 here, and they bet that the market will test the 56 high. So bears sell the high here, bet it gets to here, and what they'll do is they'll use a stop, arbitrarily a measured move up of 60. But if 61 is a bull bar closing above 60, they take the loss. So to me, I think it's better to wait. It's a good bar for the bulls, probably going to go a little bit higher, but it's a breakout from a rally that's lasted 20 bars and a second leg from the first leg that ended at bar 615. So probably going to go more sideways. But it'll be interesting to see what this bar looks like. We have obvious targets above. I'm going to go ahead and move this because I think this is a lower probability way of viewing leg one, leg two. I think most traders will agree that the first leg ended up here. But 60 is climactic, as I've said, and that will increase traders. That will increase the likelihood of some traders taking profits. Now, I may have read that wrong. So y'all are saying, everyone's saying it's paused. So is price moving now? For those in the Discord, let me know. I know that the data, okay, so it's paused. What about now? Is it moving now? Maybe I can look on my end. Okay, sorry about that. I had it paused. There's a button on Go to Webinar, and I was misreading it. I meant to turn off the screen to do something, but I accidentally clicked the pause to freeze the last frame. So I apologize that y'all were not seeing this. But anyways, the point I was making was there's two things I was saying. Let me just back up for a quick second. One, 60 is climactic. Traders will sell the high of 60, betting on a pullback, so it's a reasonable profit-taking bar. The second thing I said, I think we're going to get a leg one, pullback leg two. 60, interestingly enough, if you take the measured move from the high of low of 1, high of 11, it takes you to exactly the high of 60. And the reason for that is sometimes traders will look at the first leg, maybe two legs. So they'll say that the breakout was 1 to maybe the 11 high or one of these highs, and that 15 is an outlier. So it's, in other words, 12 was the first leg down, 15 was a pullback, 40 was the second leg down. But the reality is this is so tight, I think more traders will view the leg one, leg two from the bar 1 high to the 15 high down to the 40 low. And it corresponds reasonably well with a measured move of the low of 40 to the high of 15. Now, 60, I mentioned 60% chance we'll probably get a small second leg up. But look right here. We're 20 seconds left in the bar, and the market is not even, it's spending a lot of time going sideways. So that's a warning that the bulls do not have a lot of energy up here, and the bulls are deciding what to do. I also think it's a problem that we haven't touched the moving average since bar 42. So probably buyers below 61 for a second leg up, but every new high we get, eventually we're going to fall below a lower high, and 61 and 60 are climactic, which will increase the chance of a pullback. So in general, whenever you get when you get a bar like 60 that might be exhaustion, but then you get follow through on 61, a lot of traders will exit on the close of 61. The bears will exit because it's follow through, and if it's going to be exhaustion, it should have reversed on 61. And it's also a small pullback trend, so there's a greater risk of an upside breakout. One of the most important things with trading is to just be comfortable with what you're doing. You do not have to take a lot of trades. What you have to do, though, is be in the right frame of mind for the trades that you are taking. So it's easy. I think it's classic for a lot of traders starting out to overtrade, and they end up really damaging their performance. Okay, I want to talk about the dollar yen for a moment. Well, actually, I want to talk about two Forex markets. Forex markets are great to trade on higher time frames, 30-minute charts, 60-minute charts, 15-minute charts, daily charts. And they're great because they allow traders to trade small, whatever time frame they want, and not overexpose themselves with risk. If I can type correctly, there we go. So here's what I want to show. Here is the dollar yen. Classic example of a second leg trap. We have a strong rally, deep pullback, 3 pushes down, and then we rallied up to here. And then we get this violent 2-bar breakout. But look to the left. When you get a leg that looks strong and it's at the top of a trading range, and you look to the left, and you could argue, it's not the low. In other words, it's not here. It's late in a rally. This is an attempt by the bulls to make this a trend. And you look to the left and you think to yourself, this is good and all, but why are we not above this? Why are we at an obvious point where the bulls failed? So you look at this, and it's common logic to think it's a breakout. It's going to have a second leg. Well, it might, but whenever you see this, a lot of traders get out for a few reasons. One, most traders buying here, they'll have a stop somewhere down here, but then they see that, and they know the probability is not 60% chance that we're going to go here to here. And since I've talked about, let me check this. So I think we're going sideways first. We'll probably get up there, but risk reward's tough because we may pull back first. So I think certainly reasonable to take profits, especially if you bought down here. But let me go back to this, because what I want to point out is risk reward. It changes with every tick. And you've heard me talk about this spreadsheet. Let me pull it up real quick. Okay, so I've mentioned this spreadsheet before, and pay attention to this one right here. I'm going to just hide the others so it's not distracting. 60% chance risking 1 to make 1. So you're long, you buy the close, stop down here, target up here. So in other words, look at the pink lines. 1-to-1 risk reward, yes. 60% chance, sure. You get follow through, good for the bulls. Now, technically your risk is from the close of this bar down to here. So your risk reward is actually, your target is further away. But even if it's not, then you get this bear bar. What's the probability that the market's going to go here, where my mouse is, before it goes down here? And why am I bringing this up? I'm bringing this up because it's important to realize that your trader's equation changes with every bar. And it's 0.2, so it's marginal. This is your return. That's marginal return. So let's say this bear bar brought it down to 55%, 0.10. You will inevitably lose money at 55% at 1-to-1 because after you pay commission, after you account for hitting the wrong button, selling when you should have bought when you should have sold, human error, you're going to lose. 53%, you're definitely losing. So the point is, when everybody agrees that this gets less than 50%, you get this bar right here. Everybody's accepting that we're going lower. Now, why wouldn't traders buy and scale in? Because they know a few things. One, they know an obvious target is this low. It's here, it's here, it's one of these lows. And a lot of traders, they know that their stop needs to be somewhere way down here. So you have a strong breakout here and here, you're going to get a second leg down. Traders exit. But then we broke below an obvious breakout point where the low of the bar, where it's reasonable to put a stop, and look what happened. We rallied. So again, another bull bar, probably getting to these targets, so we're probably vacuuming up to it. Overall, on the daily chart, I think we're going back to the May 1st low, so this is a very impressive rally. Anyways, let me go back to the last market I want to talk about, and that's the dollar Canadian. Here's another good example. This is very similar to yesterday, but you can see we rallied in March, early March. We tried to form a pullback and get a second leg up, but instead we got a breakout and bulls got trapped here at this line. So bulls are trapped, they're exiting, but the market has memory, and look what happened. Bulls bought, they bought more lower, we're back to that area. You'll have some bulls who buy and scale in lower. However, think about the problem with that. You're buying, your risk reward's poor because your stop is probably down here. So if you're buying and your stop's down here, it's a bad trade because the market could easily fall all the way down here and reverse up. We saw that on the daily chart with the E-mini over the past 2 weeks. We get a bear bar and then an outside down bar, and look, the market retests that area. When bears make money below bars in a rally, it significantly increases the risk of a trading range, especially when you're in a trading range. And then bulls buy the close, they buy more lower, they get out break even, and then look, everybody concluded. Let me go back to that spreadsheet because it's very important. Traders think probability is 60% here. It's not really, but let's say it is. Then here, it's lower. Maybe it's closer to 50-50, so traders start to take profits. Then it lowers, and all of a sudden, somewhere in here, it gets to where it's a negative trader's equation. And when it's a negative trader's equation, you get a giant sell vacuum, and traders start selling out of longs, and bears start selling aggressively. Bulls, they buy here. Rather than stopping themselves out here, they buy more lower. So no clear top, still going higher, but far away from the moving average. So better to I think you're more in a profit-taking area up here. Someone asked about negative traders equations. Negative traders equations are typically, you think about it like this. Let's go back to the spreadsheet. Negative traders equations are, by the way, two important targets above. It's okay to take partial profit. It's okay to stay long, but to me, how much further are we going to go? So the stop's getting pretty far. I think it's more of a profit-taking zone. You're getting big bull bars, small bars, big bar, probably going to get a few small bars, probably going to pull back soon. But anyways, think about it like this. If you are risking $200, so let's say you're risking 4 points. Your reward's 4 points. Your risk is 4 points in the E-mini. Okay? And let's do it like this. Let's play around with Excel for a minute. Let's say you're going to take trade number. Let's say you take 10 trades. So you're risking, your reward's 100, your reward's 200, your loss is 200, 60% profitable. But let's not forget, we have to pay commission on every trade. So really, your reward is $195 if it's $5 for the, let's just say it's $5 round turn for the E-mini. Your loss is $205 because you got to pay $5. That means your return per trade is less than 1 point. So what that means is here's return in points. 35 divided by 50 equals 0.7. So in 10 trades, you're going to, in essence, make 7 points. The reason I'm bringing that up is this. If you average $35, you're averaging less than 1 point per trade. And all that means is, all that takes is one or two bad trades for you to mess up. And that does not include slippage. 57%, you're going to make basically 2 ticks on average per trade. That is not a way to win. 70% profitable, that's better. So the reality is most traders need more than 60% profitable 1-to-1. So getting close to the targets. Question. It seems when we trade with a wide stop and scale in, risk reward probability become confusing. Can you expand on that? Yeah, I'd love to. Risk reward, it's very subjective. That's why most traders, I think, will get into trouble scalping, because let me explain it like this. Go back to our spreadsheet. Like this. Go back to our spreadsheet. Okay, so here is a spreadsheet, and this is what I want to focus on. So let's go for, better yet, let's keep it simple. Focus on the two middle ones. Going for, at the target, by the way, still no sign of a top, so too early to sell. And we very well may try and get to the May 1st low. It's still pretty far. It's actually 82, so we still have 20 points to go. I don't think we're going to get there, but this is certainly impressive. Anyways, back to the spreadsheet. So why is scalping so hard? Here's the reason. You really have two choices in trading. You can increase your probability, and your risk reward is going to go down. It's going to get worse, in other words. Or you can increase your risk reward, and your probability is going to get worse. So let's take it like this. Which do you think is easier? The first goal with trading is to become at least neutral. Don't lose money or make something. So if you had to pick, what's the easiest way? the easiest way for most people is to focus on risk reward, because if you can be 40% profitable, you're going to make 0.2. If you're 60% profitable at 1-to-1, you're going to make 0.2. Most traders will have trouble making 60%, and they need to be closer to this number, 75% or even 70%, if they really want to make money as a scalper. And that's going for 1 times the risk. That doesn't include going for half the risk. So what that means is when you're a scalper, a lot of times you're in this above situation. Your risk is greater than your reward. And the problem with that is a few things. One, look right here. Even if you're 70% profitable and your reward is half your risk, you're going to make 0.05. So at the end of the day, most traders, the reason why they screw up scalping, they cannot exit fast enough. They will take far too big of losses, and ultimately they will screw up. So they'll sell the high of 60, betting that it's exhaustion, but they can't get out on 61 or 62. And then they take a huge loss, and that totally offsets it. The key with scalping is really simple. You have to take small losses because you're going to make small winners. And if you can take a lot of really small losses, or if you can take a few small losses and a lot of small winners, it will be a great strategy. But you can't have big losers. So you can't sell the close of 40 and get out on the close of 50, 50 or 49. That is too much. You can't buy the close of 14 and exit at the bottom of 12. That is how you lose. Most traders, if they focus on this, focus on buying above a bar like 6, stop below 6, Al calls it the Walmart trade, hold for 2 legs, and exit below bear bar. Try and get twice your risk. Focus on buying a bar like 41, stop below 40 or 41, and holding for twice your risk. Because if you can increase your probability and go for twice your risk, so in other words, this right here, if you can get your probability closer to 50, or even let's just say 45, you're in a lot better position to make money. That's why most traders should focus on always in. So, okay, you're really far from the moving average, and this could go on for a long, long time. And obviously, I look like an idiot saying that traders, it's okay to take profits on 60, because 60 was at 41.50 and now we're at 41.60. But the reality is, this is not normal behavior. This is extreme behavior. And extreme behavior can last a long time. Al would always say, the market can stay irrational longer than you can remain solvent. And obviously, I don't remember who said that, maybe Warren Buffett, someone famous said that. But the point is, if the market's doing something that is low probability, it can stay low probability for a long time. So when you see consecutive bull bars, even though you have 1, 2, 3, 4, 5, 6, 7 bull bars in a row, don't sell and say, oh, we're going to get an 8th one. And let's look at what happened earlier this week. We had 25 bars that were bear bars in a row. So you can look at 11 and say, that's extreme. We're not going to get any more bear bars. But can you stay solvent from 11 all the way to 25? And more importantly, can you scale in on the way down? Because what good is it to buy the close of 11 and not scale in lower and get out, break even at the 11 close? You didn't make any money. You lost money technically on the way down, and then you made it back, sure, but you're still at 0. So it's overall a dumb trade. So here, the only thing you're doing is buying or flat. And if you're flat, who cares? There's so many trades you can take in a span of a day. You don't need to worry about this. You need to worry about doing the right thing when you're trading. That is how you become profitable. Okay, question. This was at 12:28. Is it generally true a 5 to 6 bar microchannel with closes on its highs? In other words, buy the close behavior leads to second legs? Yeah, that's true. A microchannel is a breakout on a smaller time frame. So when you get 3 or 4 bars, let's look at the rally. Look at the rally from bars 1 to 4. It's a breakout on a 20-minute chart. It's 1 bar. So a 5-minute breakout like 60, or better yet, 40 and 41, this tail and this bull bar, we know on the 1-minute chart, it's 5 or 6 bull bars in a row. So it's a breakout. And that is a microchannel, and breakouts lead to second legs. Follow up with the question. I've heard you mention that, and recently hear Ali interviews noting that. Yeah, Ali's a big proponent. For those of you that listen to him, he's released a couple of he's got a couple interviews he's done and released some of his own videos talking about that. But it's the same thing Al's saying. Look for breakouts and look for second legs, because breakouts have second legs. So you're exactly right in what you're saying. The trick with all of this is figuring out what breakouts are too climactic where there's going to be a reversal. So like right here, who wants to buy almost 20 points, 15 points away from the moving average? The only reason you're buying up here, you're not looking at this and saying, this is so valuable, I've got to buy. You're saying, wow, this is extremely expensive. It's kind of like the greater fool theory. You're buying, betting on momentum. Well, look what just happened right then. Momentum's drying up. Traders are taking profits. So the traders that are buying, it's a buy the close rally. They buy, they put a stop below, breakout, put a stop below, put their stop below, new bar, stop below here, 65, stop below 65. Then, as it goes up, guess what they start doing? They're selling. Now, why would a trader sell out of longs here? Because if their stop's here, why let it get hit? You know the market's going to fall below a bar. You know, I joke about it, but it's kind of like roulette. Whatever the game, the roulette game in casinos where you spin the ball on the wheel. If it's rolled on black X number of times, you know it's eventually going to roll in red. So if you have 5 bull bars in a row or 7 bull bars in a row, you know the probability is less for an 8th bar. So to me, this is profit taking. Momentum's drying up. Let's look at a 1-minute chart. Here you go. We're rallying, becoming climactic, and then look what happened. Everybody starts to sell. So in 2 minutes, we've gone from 62 to 58. And we can sell off pretty quick. We're probably going to go sideways, but to me, this is enough selling pressure for a second leg down. Now, for me, do you sell here? I would not. Yes, we can sell off quickly, but look at the momentum up. That's a lot of selling. That's a lot of momentum. And if you're selling right here, where's your stop? You put it at the high of the bar. So then the next question is your stop going to be from the high of here and target here? What's the probability you're going to go down here before you go here? I don't think it's 60%. We could sell off quickly and get down to here, sure. But in general, when I see a tight bull channel, I assume sideways is more likely. So I'll be happy to sell after I see other traders make money selling. But this is what I was talking about. Now, the one risk the bulls have is consecutive buy climaxes. And if traders are if they want to get out quickly, bulls that bought the 65 close and they're disappointed with 66, if they want to exit quickly, we could collapse very quickly to the 61 low or the 63 low. So if this starts to get selling pressure, we could go down pretty fast. You can see here's a leg 1. Maybe it started with leg 1, 40 low, 56 high, pull back, 59. You can see ticks on the way up. Ticks got close to 942, they almost got to 1,000, and then they finally got to 1,000. Often when you get ticks to 1,000, you often have a new high with lower ticks before a reversal. But this is pretty strong and going down pretty quick. I think a lot of traders will be quick to take profits, but I would not be surprised one bit if we have to get to a new high and form a lower high in ticks. So why is that? It's kind of like volume divergence, where you rally on high volume, even though this is ticks, same thing. You rally to 1,000 on ticks, but then you get a new high with less ticks. So the S&P, obviously, the more ticks from the overall New York stock, the overall stock market, U.S. market, the more ticks that are going up, obviously the indexes are going to go up. But when you have a new high with less ticks, that's a sign of divergence. You don't need to look at that. And good ticks can be helpful when you want to kind of verify a small pullback trend. Here, like you see a lot of bull bars, tight bull channel, and then you start seeing a lot of bars closing above zero. That's a warning that you're in a small pullback trend. You'll see some traders probably getting out break even at the 65 close. Yeah, Lyndon quoted what I said about don't worry about missing out on a trend, worry about doing the right thing when you have a position on. That is just things I've heard Al say years and years and years in the trading room. You listen to Al, you'll hear him say it. And I think Don McAllister said the same thing above. You listen to Al, he's so peaceful about anything. You know, I'm sure if we go back and listen, I believe Al was talking during the sell-off that happened on Monday. He was talking about during this. And I'm sure he was just peaceful. I'm sure he was actually more fascinated by the fact that we had 25 bear bars in a row. But his mentality was, who cares? You know, what an event. So you do not, the longer you trade, the more you realize you don't need a ton of trades. You just need a few really good trades every day. And there's just so many trading opportunities in a day. Bitcoin starting to go sideways. You can see gold futures contracts, 2 legs up, but testing resistance. So the bulls that are long have a stop down here. But here's the interesting thing, and that is, if this is a trading range, and everybody agrees we're in a trading range, guess where our logical target is? All the way down here. So we could easily get a sell vacuum down here and go sideways. I wouldn't buy 67, but probably there might be more sellers above 67, and we may get a small second leg down. In general, someone's asking about measured move targets. Generally, if a market goes a couple points above a measured move target, really even a couple ticks beyond it, it's ignoring it. So when I take a measured move from the 40 low to 42, and we're breaking above it clearly, I ignore it and I look for other things. So maybe a measured move from the 40 low to one of these highs, maybe this high up here, that's probably too far. Maybe 50, 51, that's a strong bull bar, but we went above that. Another target may be the 59 low to the high of 61. Takes you, or basically to the high. 325 is the high. The market went to 325. So it looks like the market, we had a breakout from the 59 low to the 61 high, and the market is respecting that. But like I said, probably sellers above for a small second leg down. Still a small pullback trend though. Okay, question. This was at By the way, whenever there's sellers above a high one, they're usually brief. High ones often lead to pullbacks and second legs. So even if you pull back, if there's sellers above the high one, there's sellers for a scalp, and they often get trapped. We saw that on bar 6 today. Bears, they sell the 6 high, they get trapped on 7, and they give up on 8, and that's what leads to higher prices. High 1, 54. They scaled in, they got out break even on 58, but they were so disappointed by the bears that sold and scaled in. More bulls bought the 54 high during 58, and bears bought back shorts. Okay, back to the question. What is your opinion? Okay, what's your opinion? Do we break out and go higher towards the August high? This was at 124, so around 62. Do we break out and go higher towards the August high or lower towards the year's low first? Just curious. Yeah, so what do we do on a monthly chart? Let's just talk about a daily chart. Keep it simple. So in your opinion, what are we going to do? Well, we have a double bottom. We have an expanding triangle. So it's possible flag and a leg 1 from March to here, pull back, second leg. I think the market wants to get above the February 2nd high, this blue line. However, with that said, we rallied, we failed. We rallied, we failed. We do not yet know how many traders want to get out at the May 1st low. To me, the momentum up on yesterday and today are strong enough for a second leg. So the odds are we're going up to here. But if we start to stall, then the odds will lower. For the bulls, they need to get 2 or 3 bull bars. They need to break above these highs. So it's kind of like on the 5-minute chart during the FOMC report. We started getting all these bars, and it's just a mess. It's an expanding triangle, basically. But then eventually you get this big bear bar and follow through, and you're breaking below the range. The bulls need to do the same thing here. They need to break above the range. But by the time they break above it, we will be at a new high. So if the bulls can get, especially if tomorrow, Monday, is another big bull bar, that will increase the chances of higher prices. But on the monthly chart, just look at this. We have a strong sell-off, big rally. This is a mess. So even if the market gets all the way back to the January highs up here, you know what's going to happen. There's probably going to be sellers up here. So I would not be shocked if in the alternative, we had a big sell-off, deep pullback. We could go sideways and go all the way back down here. Well, not back down there, back here. So let's look at a weekly chart that's easier to see. I'm going to get rid of this. We have a bear sell-off, tight trading range. So right now, this looks good, but it's basically overlapping bars. We could break to the upside, but we could easily go back to 4,000. Eventually, we're going to get to the moving average. So we have a sell-off, 67, pullback. Bears have not made money since 39, so now we are actually coincidentally, we're 30 bars. So bears have gone 30 bars without making money. Below bars, they've made some money above bars, but not much. Important to realize, it is bar 72 we're close to bar 72. Obviously, it's bar 70. And what's important to realize is we've had a buy the close rally for a number of bars. We're probably going to go sideways for the rest of the day. And this right here, I think we're going to get to the moving average. I'm confident about that. And any one of these sell-offs could be that move to the moving average. So whenever you're buying late in a rally, it's like, look at 60. Let's do it like this. Out of curiosity, remember I said there were bears that would sell the high of 60? let's see if those bears are able to sell. And in other words, let's see if the market gets back to the red line. I suspect it probably will. And that is the challenging part with buying high in late in a day. Buying late in a rally is that when you get the reversal, it can be, fairly abrupt. So at a minimum, I think we're going to the 60 high because it's reasonable to sell the 60 high. We're probably going to get to the 60 close as well. You can see we came close to the 60 high and starting to reverse up. Some bulls buying the 67 low, scaling in. There's bears disappointed down here that scaled in, and they're getting out break even in this area. So for the bulls, no surprise. You buy the 67 low, scale in, make money. It'll be interesting to see. Can the bulls that buy above 66 or 67 and buy more lower, will they make money? And the reality is they probably will. Okay, I'm going to step away for about 10 minutes, but we'll have the end of day review. I'll talk some more a little before that, but you're not going to hear any talking for about 10 or so minutes. Yeah, someone's asking if they can hear me. I was trying to move my mouse. I wasn't talking, I was just trying to move something on it. But anyways, I'm still here. Let's answer a few questions. You can see we're testing back in that zone. Possible exhaustion, 61, but then 62, and possible exhaustion, 61. Then bulls got followed through, 61, 62. 60 is an exhaustion bar, but bulls got followed through. We broke to the upside. But you can see this area is an area where bears got trapped, and they're buying down here. And we're at the moving average finally. There we go. How many points on average is needed for a healthy 2 times risk reward trader's equation? Well, it depends on your risk. I think what the person's asking is, what's the best way to achieve twice the risk? And the way I look at it is this. Let's see if we can, let's do this. Go to the blog. Click on today's report. I don't remember where I said it, but I say it most days. There's an 80% chance of an opening swing. It's really higher than 80%. It's just 80% is good enough. So basically, it happens every day. And it provides a great risk reward for traders. Most traders should try and catch the opening swing that will often begin before the end of the second hour. So what that means, typically before bar 24, there's a reasonable swing trade. At least 40% chance that swing trade will double the range. Next, the swing trade often forms after a double top or bottom or wedge top or bottom. So traders should look for one of these patterns and see the chart for details. Here's that chart. We have a gap up, we rallied, pulled back, kind of formed a wedge bottom, but a double bottom. You can buy here, stop below. In general, 40% chance the range is going to double. And it's, let's say it's a 40% swing trade. What's great about it is if you're buying here, stop below, it's a 40% chance to go all the way up to here. And you would make many times your risk. Other traders, they wait and buy maybe here. But either way, it's a reasonable probability you're going to test the high of the range. And it's decent probability you're going to go all the way up here. Sold off, bar 1. But what we know, 20% chance bar 1 is typically the low or the high of the day. You get a pullback and a double top, and then you get a big bear bar. Reasonable sell, whenever you have a double top or double bottom, you often get a deep pullback that makes it seem like it's going to reverse, and then a second leg down. We have here, wedge, decent bull bar. Whenever you get a decent bar on the open and you break below it, it increases the chances of a trading range. So big bull bar, 1 push down, 2, and then 3. Bulls buy, 40% chance maybe we get a measured move up, but you can see they can hold for several bars. So the key is, 1, do 2 things. First, try and identify reversal points. 3 legs down, 1, 2, 3, after a strong rally. Buying above 41, stop below 40 or 41 is a reasonable trade. So think about it like this. Think about the market cycle. So I'm just curious if we can, let's try this. Give me 1 second. Oh. I'm going to pull up something about the market cycle. Here's an old screenshot of the trading course. And again, these are just their screenshots. But anyways, this is from the first market cycle video, video 12A. And the reason I'm bringing it up is you have a breakout, strong breakout, probably buyers below. So buy for any reason. You have a tight bull channel and still it's tight, buy for any reason. But then eventually you get a broad channel. You have a rally, deep pullback. This deep pullback tells traders that there's going to be sellers at a new high. So you can, I wish it wasn't it's hard to see with this, but you can sell a new high. And the reason for that is whenever you get 2 legs up in a trading range day or a trading range or a broad channel, there's a greater risk of deep pullbacks. Here, you have a strong rally, deep pullback. This rally here is a second leg. Then you get a strong sell-off. This sell-off is the second leg. So the whole point behind that is you have to be very careful trading after first legs. So anyways, I'll talk more about that, but the point is leg ones typically lead to second legs. Very common. Breakout, you have a breakout 69.70. There's odds are you're going to get a small second leg down. And, bars 1, 2, and 3, strong enough breakout, you're going to get a second leg up. But eventually, bars 12, 13, and 14, it's a third leg. That lowers the chances of another leg up, and it increases the chances of a pullback and a test of the 12 low. So just like here, late in the day, we could easily sell off down to the 60 low or the 59 low, because arguably first leg to 14 or 15, pullback, second leg to 56, pullback, third leg up to here. And the other thing to remember is whenever you have a strong trend day, it's very common to get a sell-off late in the day to put a tail on top of the bar. Most traders should do nothing here too late in the day, and we could easily sell off down to here. We could easily reverse back up to here. So probabilities are really not that great. And generally, if you're trading in the 5 minutes left in the bar, 5 minutes left in the day, it's some form of trying to make up for something in the past, and that is not what you do. Okay, I'll answer questions at the end of this. Overall, interesting day. You can see we're forming a tail on the high of today's bar, but trading range price action, we sold off on the 26th, bounced to a new high, sold off on the 4th of May yesterday, and we've already undid all the damage. And one of the kind of tailing signs was, look right here, it's hard to see, but the sell-off to May the 3rd, not May the 3rd, May the 2nd, we had a big sell-off and a big tail below the bar, and then a big rally. So if you think about it, we went down to here and all the way up to here, and that is a sign of weakness. Look at a 60-minute chart really quick. Big sell-off, really deep pullback. So what did I say? I said traders would buy the new low and scale in. We also had support down here. So we sold off, had a very big bounce, and then a second leg down and found support at these lows. And we kind of had that on a 5-minute chart. We had that on a 5-minute chart maybe last week. Let me just scroll back and find the day really quick. Here it is. So we had this big sell-off, 20th, bar 20, 21, 22. And the interesting thing about it is 22, it's a good bar. It sold off pretty far. But look what happened. It went below 8, went below 7, went below 11. And by the way, this is May the 1st. And then it rallied sharply. Sold off on 22 and rallied almost back to the breakout point of 21. And then you got a second leg down. So it's a micro double bottom here. We had a sell-off, and it was really just one move down. So there wasn't a sell-off and a deep pullback. And then the bears got a second leg down. So the point I'm making is whenever you get a big sell-off and then a deep, deep pullback, and then you get the second leg down, there's a greater risk of buyers somewhere below. And I know that that's probably one of the most frustrating things about trading. It just takes a long time to really look at that and see, and that is you get these rallies and then these deep pullbacks, but these pullbacks are testing prior lows. So a trading range, everybody gets trapped, and the traders that are fading breakouts, they bet that traders are going to remain trapped. So we break above December in around February 2nd, we reverse. We get a strong breakout February 2nd. Traders using a wide, traders are betting on an upside breakout. Then the market starts to go sideways. And this is what I've talked about with the traders equation. Traders buy anywhere, stop down here, and then the market starts to go sideways. And then they start to say, yeah, this is not good for the bulls. This is a sign we're in a trading range. And before you know it, we just start selling off all the way back down to the lows. We get 3 big bull bars, but look what it tested. It tested the 10th of February and led to a second leg down. So what do I think is going to happen here? Well, I think that we're probably going to get a second leg up, but I expect the bulls to get disappointed. So this line right here, which is pretty much the December 13th high, the market is, and I still have it wrong just because the market's responding to it. It reversed. It went up and failed, went up and failed, broke above it, failed, tested it, failed, tested it, failed. And this red line here, of course, now I can't grab it because let me try this. There we go. So I think we're going to try and get up here to the May 1st high. But we could easily get a deep pullback first. Eventually, we'll get a measured move up or down. But right now, we do not have, we're in the middle of an expanding triangle, and that is an area of agreement at right at 41.50. Weekly chart, rallied and overlapping bars, probably going to try and get to the February 2nd high, but this is bad follow-through for the bulls. So unless the bulls can get a strong upside breakout, we'll probably test up and fail. But even if we get to the February 2nd high, you have to wonder about some kind of wedge, leg 1, leg 2, leg 3. So in other words, a test up to, we rallied on December the 9th, we rallied on February 2nd, we're probably going to try and rally again up here. And that would also correspond to these bulls over here that got trapped. It was reasonable to buy the close of August the 12th. And they got trapped on August the 19th, August the 26th, and even this bar here. So bulls got trapped buying here. And you know some of those bulls are bought and scaled in. So this area is going to be resistance. Somewhere around here to here. This is a resistance level. Just trying to find a switch to the microphone. Give me a few seconds. Okay. There we go. So first bar of the day, we gapped up, and anyways, we gapped up, and bar one, bull bar, closing on its high, probably going higher. Big enough gap, probably buyers below, but 20% chance bar one is the low of the day. So in general, it's better to wait for consecutive bull bars before looking to buy. Bar two, we have an inside bar, bull bar closing on its high. In general, when you get consecutive bull bars, higher probability that it's always in long and you can buy for any reason. But really, still not all that clear. And then three, bull bar, bigger bull bar closing on its high. It's basically two legs up. We rallied to one, pulled back on two, and now we're getting a second leg up, 2-3. With three consecutive bull bars, it's probably going to be either a bull trend or a trading range day, which means buyers below and scaling in lower. So you know two things from the offset. You know that you can buy the close, and you can, what you know is you can rule out one thing. It's not going to be the bear trend day. So what that means is, trading, what's important is to rule out, there's a lot of decisions you have to make. And you've heard Al talk about binary decisions. Is the market a trend or a trading range? And we know there's three market cycles. You can either be in a trading range, there's really two. You can be in a trend or a trading range. If it's trending, you can either be bearish or bullish. So on the open, the faster you can rule out, is the market in a bull trend, is it in a bear trend? The more things you can rule out, the more accurate you're going to be. So with three bull bars, probably going to be a bull trend or a trading range day. So bulls buying and scaling in lower are probably going to make money. That means the downside is probably limited. So it's reasonable to buy the close, stop below one. Some traders, they'll look at it and just say, if I buy the close of three, it should not fall a measure move down of the bar. But either way, reasonable to buy, betting on a second leg up. Or we have an inside bar. Actually, went one tick above the bar, but it's followed through after bar three. Now the problem with fours, it's similar to bar two. Bar one broke out, bar two is a small bar, but it's followed through. Bar three broke out, and bar four is small bar. So it's a big bar, and then a small bar, big bar on three, and then a small bar on four. It's still a micro channel, which means probably buyers below and scaling in lower. But then bar four, what happened? What happened on the open of five? You had traders buy the close of three, disappointed on four, and some of them started exiting on five. And the reason for that is those bulls buying the close of three, well, they were buying because of momentum. And because of that, the bulls buying on the three close, they were disappointed with four because four was not another big bull bar. They sold out of longs. Still, probably buyers below four, scaling in lower, buyers at the one high. Some bears sold above one, they sold above two, disappointed on three. So what are they going to do on a retest? They're going to buy. You have other traders who look at this and say, yeah, the rally's good, but most rallies have 50% pullbacks. So I will buy if the market pulls back 50%. And they'll buy around here. and you can see it didn't quite get there. 6, we have an inside bar, and it's a high one buy. High one buys are reasonable buys when you're in a strong breakout that's likely to have a second leg. So what does strong breakout mean? Strong breakout means that you're probably going to get a second leg. So it's reasonable to buy above 6. You could also argue that 4 is the first attempt down, which means 4 is a high one. It's implied. And then 5 is a move down. And then 6 is the second leg down. But to me, I would look at it as 6 is a high one, probably going higher. So probably buyers above 6. What we don't know is, will the market fall below 6? And if it does, it will probably reverse up. So some traders buy above 6, stop below 6. Other traders buy above 6 and buy more below 6 with a wide stop. 7, bull bar, closing above all the bars to the left, probably going at least a little bit higher. With the breakout on 1 through 4, reasonable to expect a second leg up. So leg 1, pull back leg 2. We also have the midpoint of the week, which I mentioned several times, is right around this area. The high of May 1st, low of May 4th, midpoint somewhere in here, which means we're probably going to get there. And then bar 8 is another bull bar. It's climactic. It's similar to 3. We got a big bar on 3. We pulled back for 3 bars. So you know bar 8 is testing the midpoint of the week. You know we're probably going to hesitate for at least a few bars. But 4 bar micro channel, 3 bars closing on their highs. Every bar except for bar 5 is closing above its midpoint and almost on its high. So that is a sign of strength for the bulls. So 8 is still by the close. 9, bad follow through, similar to 4. With the strength of 6, 7, and 8, probably buyers below 9 scaling in lower. 9 is also a bad stop entry short, and if it's too obvious, we may just go straight up. Some traders, rather than buying the 8 close, they want to see the follow through, and 9 is a bad stop entry short. So therefore, if it's a bad stop entry short, it's a good limit order buy below 9. But if it's obvious that it's a bad limit order buy, everybody will buy before it gets below 9. So that means some traders will just buy the close, betting we just go straight up. 10, a bull bar, broke above 9 and starting to go sideways. And then you can see 11, second leg down. It went outside down, below 10, below 9, testing the breakout point on 7. But this is the first. Bears are still not making money below bars, so probably going lower and probably buy the close and traders scaling in lower. Until the bears can make money below bars, most traders will only look to buy and buy pullbacks. 12, basically a second entry buy. We triggered the buy above 10. We broke below it. We have a bull bar on 12, so you have to wonder if this is a second entry buy. So reasonable for traders to buy above 12, maybe stop below 6, betting on higher prices. Good follow through 13, still by the close. Good follow through bar 14, but now we have a parabolic wedge, 4, 9, and 14. If 15 is a bear bar closing on its low, it's probably okay to exit. But 15 is a doji. Some bulls that bought the close of 14, just like the bulls that bought the close of 8 right here, they will be disappointed on 9. So if you buy the close of 14, disappointed with the follow through, a lot of traders will look to exit around the 14 close and try and buy lower. And you can see that's why the market gapped down on the next bar. It just went straight down as soon as the bar opened. 16 is an inside bar. It's a possible final flag. It's a high one buy above 16, and it's a bear bar, so there might be more sellers above 16 than buyers. 17 triggered the buy above 16. High one buy, but probably going lower. And then 18, we have a second leg down. Let's do one thing really quick. Tight bull channel, so probably buyers below and scaling in lower. 19, we have a bull bar. Just fixing the mic really quick. 19, bull bar, testing the high of 14. Probably sellers back above. You can see we had a perfect leg 1, pullback, leg 2. Bulls bought the close of 14, disappointed, getting out break even. And then 20, we went outside down. We went one tick above 14 and immediately reversed down. Now, what about selling the close of 20? Some traders will, but the reality is bar 20, it's a big enough surprise. It may get a second leg down, but it's also a second leg down from the sell-off of 18. And it's a third leg down if you include 16. So we sold off on 16, rallied, sold off on 18, rallied, and we're selling off on 20. That will increase the chances that the market is going to go sideways in here. And then 21, we have a big bull bar closing on its high. Possible wedge bottom, testing the high of 12. You can buy above 21, but it's forcing you to buy in the middle of a tight trading range, right at the midpoint of the week. So probably going to go more sideways in here. And then 22, we have a bear bar, 23, an inside bar. Whenever you start to see all this, it's a tight trading range. It becomes low probability. The odds slightly favor an upside breakout because we're always in long. In general, if you're trying to figure out the directional probability, typically look to the left, and whatever the prior breakout was, when it's in a trading range, the odds will slightly favor more in that direction. Slightly means maybe it's 54% for the bulls, 46% for the bears. But the odds favor trend resumption slightly more than trend reversal. We probably have to get to the moving average though first. What about buying above 23? It's a 4-bar micro channel, so it's not really ideal, and it's forcing you to buy just above the moving average, and 23 could be a trap. 24, a good bar for the bulls, but testing the highs up here. We have a high, we sold off, we have a lower high here, sold off, lower high here, and we could easily find more sellers. And then we have a pause bar. The bulls that bought 24, they wanted the market to race up. They're worried it's in a trading range. When they see bar 25, the momentum stalling, you know what they're going to do. Some of them will exit. And that's what happened on 26, and that's what happened on 27. The reality is you're in a tight trading range. There's buyers below 24, buyers below 26, buyers below any of these bars. In trading ranges, it's really common you typically don't get to, 3 consecutive bull bars, 3 consecutive bear bars, 4 consecutive bull bars, 4 consecutive bear bars, especially in a tight trading range. So when you get 3 bars down, traders start buying, and then you get a bull bar. You get 2 bars up, traders start selling, you get a bear bar. So alternating bars. And you can see the range is getting fairly tight bear channel down. At this point, we've been going sideways for most of the day. If you think about it, you can basically draw a box around these bars. Let's take a rectangle. So if we take all of these bars, we've been in a trading range for most of the day. We rallied, bull breakout, but sideways for 6 bars, bull breakout on 7, and then sideways for a lot of bars. That will increase the chances that we're going to continue to go sideways. Big bull bar on 35. Is it by the close? It might be, but it's a tight trading range. There's probably sellers above, and you can see as soon as the bar closed, trader sold. So the key here is to not get excited. Wait for a clear upside breakout or downside breakout. And then 40, I thought that was interesting. We broke strongly to the downside and gave the appearance we were going to break out, but in reality, all we did is test the 6 high. And the bears got trapped selling on the way down, it's a possible third leg down, leg 1, leg 2, leg 3. So traders selling here get trapped on 41. A lot of those traders exit. You had some bears who sold, tried to sell more higher, but when 41 closed, most of them gave up, and that's what led to a strong bull bar. 41, 42, back to always in long, probably going to get a second leg up from 1 to 15. Reasonable to buy the close of 42, buy the close of 41, betting on higher prices. The one thing I mentioned was we were not above the bar 18 high of the day. And because of that, and because of that, the odds favored the market getting above the 18 bar range. Typically, the first 18 bars, the market has formed either the high or the low of the day. So what that means is we're either going to break above 15 or break above 1, break below 1. And you know at this moment, the odds favor the market breaking above 15 before it gets down to 1. So I thought that increased the probability of buying the close of 42, betting on higher prices. 43, still buy the close. You can see any of the bears that sold here and scaled in are trapped. And then Doji 44, we're trying to form some form of double top 36, double top 44, double top with 25, 44. But this is too tight of a channel. 44 is a warning that we might start to go sideways fairly soon, but we're stalling right below an obvious target, and we're probably going to have to get to the target. Since it's a wedge, 22, 34, 40, reasonable to expect 2 legs up. So leg 1, pull back leg 2. In general, when you get a wedge, you typically get 2 legs that are at least half the amount of bars in the wedge. So if this wedge began with 21 through 40, then you should expect at least 10 bars in 2 legs. 46, bull bar with the doji, tight trading range, but still probably going higher. And then obviously we got to the 18 bar range. At this point, we have open gaps, high of 40, low of 44. And it's basically a micro channel with the exception of the 46 low and 45 low. So probably buy the close and bulls buying more lower. 50, a doji. What about selling? In general, it's typically better to wait and see traders making money selling below bars. And it's more dangerous to sell as the market's going up in a fairly tight channel. The odds were that there'd be disappointed traders up here. But 41 and 42 traps bears. And as the market keeps going up, more and more bears start to wonder, maybe we're going to test the 15 high. And then over here, they start to wonder, maybe we're going to break far above and go for a measured move of 40 to 15, projecting up. And then 51, bull bar, follow through 52, and then a doji. It's basically a parabolic wedge, 5, and then maybe 49, 52, or you can say 49, you can say 50, and then 51, pause, 53, so 1, 2, 3. But whenever you have a parabolic wedge that's a micro channel, then that increases the chances that the market is going to go more. Parabolic wedges typically mean the market's going to go sideways. So when you have a tight channel, it's a breakout on a higher time frame. 54, we have a bull doji bar. It's a high one buy, but tight bull channel. So there's probably buyers above and buyers below. It's testing the 15 high on the 54 low, so that is a measuring gap. 56, follow through, and then 55 follow through, 56, a bear doji. But with the selling on 52 and 54, we may pull back to the 54 high. Whenever you get a tight channel and then you start to fall below bars, especially when you start to fall below, strong bull bars, it'll increase the chances of more sideways. But the sideways typically leads to a trading range and then trend resumption. It's a major trend reversal. We rallied, we got a trend line break and a new high. The problem is it's such a major trend reversal that it leads to trend resumption. Most major trend reversals are trend continuation patterns to begin with. And then we're just going sideways. We finally break to the upside on 60. And you heard me mention, I thought 60 was exhaustion. And I said in general, 60% chance you get an exhaustion bar that has a second leg up. So 60% chance there's sellers above 60. Well, let me restate that. 60% chance we get a small second leg up. I said bears will sell the 60 high, betting that the market pulls back maybe 50%. But my one concern was we're breaking above a lot of bars to the left, and we're basically breaking above the trading range. So we have a trading range from the low of 40 to the high up here, a leg 1 from the low of 1, rally to 15, pull back to, so bar 1, 15, pull back to 40, leg 2, and we have such two obvious magnets not far above that I thought the market would probably have to get up there. 61, a bull bar. It did not close above 60, but it went above 60, and that lowers the probability for the bears. Some bears that sold the 60 high would probably exit on the close of 60 or 61, because those bulls the bears that sold the 60 high during 61, as the bar went up, they sold the high. They were hoping the bar would go immediately down, and when it hesitated and stalled, they were worried about the possibility of a measuring gap, so a lot of those traders got out, and that's what caused 62 and then the breakout on 63. 63, testing the leg 1, leg 2. Leg 1 from, actually that's not true, let me do this. I had it misdrawn. That is the leg 1, leg 2. So we're getting close to it, probably going to go at least a little bit higher, and then we vacuumed up to it. Now, what about buying the close? What about selling the close at 64? Betting on profit taking at the two measured move targets, measured move from the low of 40, high of 15, projecting up here. Measured move, leg 1, leg 2 from the low of bar 1, high of 15, low of 40, up to here. You can do that, but if you're selling in a micro channel that is lasting a lot of bars, that is not really ideal. It's a very tight channel, and we can still go a lot higher. So if you sold the close at 64 at the target, what do you do on 65? Not that easy to decide. But then you can see the traders that did sell and scale in are making money on 66. So 66, probably a warning that the buy the close rally is going to start to go sideways. So a lot of traders, I think it's reasonable if you bought the close anywhere and you're still long, reasonable to get out below 66, because even though it's lower probability, we could plunge down on the moving average. 67, high 1 buy, but probably sellers above, and you can see we got a second leg down, and we eventually got to the moving average and went sideways for the rest of the day. Whenever you get a rally late in the day, you typically, if it begins before 12:30 Pacific time, 2:30 Central time, which is basically bar 72, if it begins before then, typically it will not last into the close. Then the last thing to remember is whenever you get you have a strong bull trend day. So we had basically a rally from 1 to 15 sideways for a lot of the day, and then a second leg up. It's really common to get a decent sell the close finish or a sell-off at the end of the day that puts a tail on the daily chart. So if you look at most bars typically have a pretty decent sized tail above or below the bar. Bull bar, big tail, bull bar, tail above, tail below, bear bar, but a tail, bull bar, tail, bear bar, small tail, bear bar, bigger tail. And that's usually due to profit taking at the end of the day. For stop entries, I thought it was reasonable to buy above 2, betting on the gap up and trend from the open. I thought the best stop entries were probably buying above 6 and buying above 41, failed breakout of the wedge, tested the 6 high. Also buying above 42 if you want to consider that. And then probably, other than that, that's really it. You can buy above 59, but that's pretty hard to do. You're basically buying in a tight trading range, and you don't know that 60 is going to be a measuring gap and lead to higher prices. Probably okay to sell below 69, but challenging to do. We have lots of buy climaxes, very tight channel, but probably okay betting on a test of the moving average. But probably the best trades, buying above 2, buying above 6. You can buy above 12 as well. It's not, but you need a wide stop. But really probably buying above 2, 6, and 41. Limit orders, it was buy below anything for the first hour to 18 bars of the day. So bulls buy the close, they buy pullbacks, they'll buy closes and buy pullbacks, buy closes, buy pullbacks, and eventually somewhere up here, once you get to the third leg, traders start buying more below bars, worried that they're buying the top of the trading range. And then we form a triangle here. So it's bulls buying below, bears selling above. We broke below. And all through here, traders buying below bars, scaling in lower, bears selling above bars. And then here, the market got reset. We're in breakout mode. So we had a breakout, pullback, started to channel up. Then we formed a trading range down to 40. So we're in a trading range at this point. And then 41, 42, the market broke out to the upside again, and we started a bull trend. And we pretty much started a small pullback trend. And it's buy below anything in here, buy below here, buy below here. What about selling? I think it's very dangerous to sell when the bears are not making money below bars, because it's just really easy to get trapped. You get a double bottom, you sell above 58. Or you sell the 56 high and you never had a chance to get out break even on 60. Well, actually, that's not true. You did at the very end of the day. But do you really want to sell and then hold through this? Probably not. So tomorrow or Monday, it'll be interesting to see. Can the bulls get strong follow through and close at the May 1st low or above it? Or, which I think is more likely, in other words, I think more likely the bulls are going to be disappointed. Middle of the trading range day, are we going to hesitate? So if you're asking me, I expect the bulls to be disappointed with Monday. If they're really lucky, Monday will be a big bull bar, like April 27th, big bull bar going up here. Let me take a look at questions. Okay, I'm going to try and answer as many of these questions as I can. But we've kind of racked up a good bit of them. Okay, is it better for a beginner to go for a Walmart trade? For example, going for twice their risk and either letting their stop get hit or their target get hit, or get out below bear bar, closing below its low, and re-enter to continue the target. So yeah, in other words, is it better for beginners starting out to take the Walmart trade and just sit on their hands and let the trade play out? Or is it better for a trade to manage the trade? Depends on one's ability. Obviously, the more you can manage the trade, the better you're going to do, but the management can be difficult. So for most traders, they should do two things. Wait for a strong breakout that looks like it's going to have a second leg. Find a stop entry like 6, buy above it, stop below 6, and go for twice the risk. Buy here, stop below, and hold. If the market just goes straight up and the risk is small, they can scalp out. What I would focus on is learning how to trade always in. So what is always in? Always in is, always in is if you had to be in the market, long or short, that is the always in trade, always in direction. You can type in, go to YouTube and type always in or ask Al always in trading for more information. But anyways, it's always in long on 2, so you buy the close of 2, you buy the close of 3, and there's no reason to sell on 4 or 5, so you stay long. No reason to sell here, so you stay long. And then you get 3 pushes up, 1, 2, 3. Wedge, it's reasonable to take profits and look for 2 legs down. So it's reasonable to take profits from longs here. Wait for 2 legs down. Bears, maybe they sell 36, but not clearly always in short. And 40, the bears needed 40 to close on its low and probably 1 more bar to make it always in short. And then bulls made it always in long on 41 and 42. So you buy for any reason and you stay long. And there's maybe you get out here, but there's really no reason to. And then you get out below a bar like 69 or 66. Most traders should buy above a bar like 6, stop below, go for twice their risk. Buy above a bar like 41, stop below 41 or 40, and go for twice the risk. So they buy, and here they buy. 2 times the risk is right here. And that's why most traders would be better off trading something like the SPY, where they can trade partial profits. So they buy, maybe they take part off at half the risk or 1 times the risk, and they take another part off at 2 times the risk. But key is most traders should get better at swing trading. Scalping, most traders just cannot realistically maintain high probability. In other words, they cannot have a high enough winning percentage over a long enough period of time. Question: when taking setups such as wedges, double tops, and bottoms, they are not always in trades, or are they? I guess it could be always in. If we went, yeah. So are wedge tops and bottoms always in long trades? Always in shifts. So some traders are very traditional with always in. They see a breakout to 4, and they say as long as we stay above 1, it's always in long. Other traders will think about it as, here we have 3 pushes up, so we have a wedge on 16. Wedges, 75% chance to get a 2-legged pullback. That means 75% chance it's always in short for 2 legs. Leg 1, is that leg 2? Maybe, but in general, you typically get 2 legs that are 2 legs and half the amount of bars in the wedge. So maybe that's the wedge, okay? So it's probably back to always in long above this bar. But it's possible this is the first leg down in the wedge, and then you get more down. The point is, you have to learn the difference between a major and minor reversal or move. And minor moves happen in trading ranges. The always in direction shifts more frequently. In strong trends, the direction is major because it's going to last for several bars. And what you have to realize is the rally from 1 to 15 is it's a very tight channel, so it's a breakout on a higher time frame. That means there's buyers scaling in lower. But what you're asking is, when you get a wedge bottom here, 1, 2, 3, is the market always in long? Yeah, always in long. You think about it from the perspective of, where do traders have to exit? Where do bears have to exit if they are short? For me, if you see 41, you almost have to exit above 41. That means there's a high probability it's reasonable to buy above 41. If you see 42, you clearly have to exit shorts. So it's buy the close 42, and you're going to go higher. The always in direction flips when one side has to clearly exit the trade. So second entry shorts at the top of the range, second entry buys at the bottom of the range, wedge tops at the top of the range, wedge bottoms at the bottom of the range. I will expand more about always in soon. Okay, sorry about that. So always in will shift depending on the market cycle. The more you're in a trading range, the more frequent the always in direction changes, because there's no major trend direction, there's only a minor trend direction. Legs in a trading range are minor moves, which means they don't last long. Legs in a trend are major, which means they have more influence over the market for several bars. Okay, question, what is the difference between, let me just say something here. There we go, I had this backwards. What is the difference between bar 4 and 44? So bar 4 and 44. Bar 4 is a doji, and 44 is a doji. There's not much, I mean, there's a little bit of difference. Bar 4 is, you can argue that 41 to 42 is the first leg, and bar 44 is the start of a pullback. Bar 1 is a breakout, bar 2 is an inside bar, 3 is a breakout, and bar 4 is an inside bar. So it's technically 2 breakouts, 1 pullback, 2. But it's a tight enough channel that this whole thing's a breakout. I would see bar 4 as follow through from 3 and probably going to go higher. So reasonable to look at the close of 4 and say, yeah, it's probably going to go higher. 44, same thing, but the problem here is you have all these bars to the left. So there's an increased risk of sellers above and a pullback to the 40 or 41 high. But because of the context, wedge bottom, 22, 34, 40, probably 2 legs up. Was the bar 16 inside bar a good setup for a buy? Was it a good setup to buy the close? I would not. I mean, it's a little bit tricky. Because 17 went above 16, we sold off. Bar 16 should get a small second leg down. It's a wedge, 1, 2, 3. Because 17 went above 16, reasonable to expect a second leg down. If you're buying for scalps. I would rather be buying breakout points like the 12 high. My problem with buying the 16 low is we could easily sell off to the 12 low. It's reasonable because you have a wedge, 1, 2, 3, and an important thing to write down is you typically test the bottom of the third leg in a wedge, and you can see we did that on 40. Question, I got long at 73. Thinking bears are covering, and that proved to be a mistake. Yeah, that's, I kind of warned that if you're buying here, we could get a deeper pullback and test all the way to the 56 high. So to me, tight bear channel, selling 72 or 73, there's too much risk of more down. Was bar 23 inside bar a good setup to buy for the bulls? You can buy it, but for me, the trader's buying above 23. They're hoping for strong trend resumption, and you can argue it's an okay buy, but you're getting a lot of overlapping bars, and you probably have to get closer to the moving average. So if I'm buying 23 and then I see 24, the problem is 25 and 26. 25 is disappointment, so more traders start to exit, and you can see the bulls that bought above 22, 23, disappointed, 25, 26, 27. Look what happened on 28, 29. If you bought above 23, your entry price was 36.25. The high right here was 37 even, so you had a chance to get out. So for me, had I bought here and the momentum dried up, I would get out. So someone's asking about TradeStation. How do you learn how to use TradeStation better? You just use it. I mean, I've been using TradeStation really since I started studying now, and that was 2013. So I've used TradeStation. I've looked at charts on TradeStation for basically 10 years. I've actually used TradeStation. I've looked at charts in TradeStation for longer than 10 years. So you just get really used to the platform. But the way you get used to it, you just kind of play around with it. You can Google things and all that. So someone's basically asking, how long does it take to start learning all of this with regards to trading? And what I will say is, it's basically, it takes a long time. You know, if you're studying AL, you're basically getting the master's PhD version of trading. And, you know, go take Al's books, or better yet, just look at the video course and find another trading course that is 120 something odd hours of information. Go find other books that are, you know, Al's average, he's got the second series of his trading books, the ones that everybody has, it's trends, reversals, and trading ranges. Every book is about 400 pages. And really, there's more than that. But the point is, that's over 1,200 pages of information. And if you read one of his books, you know how detailed they are. So if you look at his encyclopedia, there's over like 7,000 slides. So you're basically getting the highest level of education you can get. And that means it's going to take a while, but it's also 30 years of trading experience packed into information. So the more you study it, you'll learn it at a faster rate. And I hope to make some videos over that, how to really study Al down the road. But unfortunately, time is short today, and that is a couple hour long conversation. But the key is you just keep studying. All right, so looks like that's it for questions. I'm hoping to do, I mentioned on the YouTube channel, I'm hoping to try and do a Q&A session this weekend for about an hour or so, and maybe think of one or two talking points that people need to, that I think traders should learn, and then answer questions for the rest of it. But if you're in the Discord, I will post information about that sometime over the weekend. So it'll be interesting to see where we go. Tomorrow, aka Monday, the bulls want higher prices, but the bears are probably going to disappoint the bulls. This is a strong rally, so you know there's probably buyers below for a second leg. So the question is, do we gap up and go straight up here, or do we pull back first and then go up? All right, hope everyone has a good weekend, and see everybody on Monday.